Hello everyone, I hope you guys are doing well and studies are going in full swing. In today's video, we would be discussing the entire accounting standard section from your CA Inter syllabus, full coverage with all concepts, and we will try to keep it in a very focused exam driven manner. Okay, so we'll get started. So you might have done advanced accounts from us, or you might have done it from some other material. The reference base that we are going to use over here is this book that we have, the velocity book. If you have done it, well and good from there. Otherwise, even if you have done it from some other material or the institute's material, remember the concept of accounting standards remain the same. So what you want to do over here is to kind of listen, focus and brush up all your concepts, so that when you're preparing before your exams, everything comes in front of you as a flash. Okay, so let us get started. We will be focusing on the accounting standards part. We'll go in a sequence form so that it is easier to track, and we will cover every concept area here. So let's get started. So the first standard that we'll look upon is AS1, accounting standard 1, relatively less important from an exam perspective. Over here you are explained about the constituents of financial statements. Like, you have five main constituents: the balance sheet, the profit and loss statement, then you have the cash flow statement and statement of changes in equity. Apart from that, there's notes to accounts, which also forms an integral part of the financial statements. While preparing financial statements, you have three fundamental accounting assumptions. That is a going concern, that is business will continue in the foreseeable future; consistency, that is same accounting policies are to be followed year after year; and accrual, that is mercantile system of accounting, record expenses as and when they are incurred, incomes as and when they are earned, irrespective of when they are received or paid in cash. These assumptions are assumed to be followed irrespective of they being mentioned or not, and hence we don't need to specifically mention regarding them in our financial statements. However, if any of these assumptions is not followed, then a separate note or a disclosure for the same has to be separately given, as we can see over here. There will be other principles as well while formulating your accounting policies, like materiality, like substance over form, like showing comparative data, possibility of offsetting incomes with expenses wherever permissible. However, these are not called as fundamental accounting assumptions. The three that we just discussed would be taken as fundamental accounting assumptions. Now, what do you mean by accounting policies? These are methods of implementing accounting principles. Like, for example, inventory will be accounted for using FIFO or weighted average, which is an accounting policy, or PP will be disclosed using cost or evaluation model, which is again an accounting policy. Next, where do you show these or disclose these accounting policies? These accounting policies will be disclosed in the notes to accounts, and in these notes to accounts, just a second, yes, they will be disclosed in the notes to accounts, and they will be disclosed at a single place in the notes to accounts. Now, a question might arise that merely because we are disclosing, does that mean that we can follow any policy? Well, any permissible policy can be done. You cannot say that, chalo, I want to follow LIFO, I have disclosed LIFO. So if I have disclosed, I am telling the world that I am following LIFO. However, LIFO is not permitted as per AS2. Mere disclosure does not correct a wrong accounting policy. So we cannot give in our defense that merely because you have disclosed a policy which is not permissible, we have complied with the standards. No. Compliance happens if you disclose the policies and follow policies which are permissible. Further, can the accounting policies be changed? Yes, they can be changed if it is required by the law or by an accounting standard, or you think it results in a better presentation. And when you actually change the accounting policy, if it has a material effect in the current period and you can ascertain the amount, then you will disclose the amount in the notes to accounts. However, if the amount is not ascertainable, then you will disclose the fact that you have changed the policy, but it is such that the amount is not ascertainable. When it comes to the future years, if this have an effect on future years as well, so you are changing the policy that will possibly change the position in future years substantially, then the fact that the change is material should be disclosed in the notes. Over here, determination of the amount is not mandatory. If you want to voluntarily show that, you can still do that. So that kind of takes care of the basic principles of AS1. Also, another principles for this accounting policies: if there's a change in accounting policy, it has to be retrospectively applied, like you will do in AS5. And if there's a change in accounting estimate, it has to be given effect to prospectively, and hence there will be no retrospective restatement. Okay, that takes care of AS1. Next you go to AS2. This is a standard on inventory. I would put this to be a slightly more important standard as compared to AS1. So when you're looking at inventory standard, what gets covered under inventories? Well, items that you're holding for the purpose of sale or for the purpose of consumption in the ordinary course of business are going to be covered over here. This will include raw materials, finished goods, work in progress, even stores and spares, loose tools and consumables will be covered under AS2. Items that are not going to be covered under AS2 in terms of the scope coverage would mean work in progress under construction contracts. Why? Because there's a separate accounting standard, AS7. Then you have shares, debentures held as stock in trade, because this is a separate standard, AS13. And inventories of certain agricultural or biological products like livestock, forest products, etc., which will be recorded at NRV only. So these are the items which you might remember, let us say, from an MCQ perspective. Now, there are three important principles in your AS2. First, at what value will you initially record inventory? Well, initial recognition will happen at cost. We will study some detailing over there. Second, how will you record the flow of cost? If there's a particular item going out, how will you find the cost of that item? Cost flow assumptions. And last is valuation. So, when you look at the cost, initial recognition should happen at cost. For purchase inventory, that will include the purchase price plus the non-refundable taxes or non-creditable taxes. Refundable or creditable taxes are not cost for us, and hence they will not be included in the cost of the inventory. So purchase price minus trade discounts, if any, plus non-refundable, non-creditable taxes, plus directly attributable expenses to bring the inventory in the location and condition as desired by the management. So if I'm importing inventory, then all of these import cost, transit, insurance, packing, unpacking, loading, unloading are directly attributable to get the inventory in the location and condition as desired by the management, and hence should be capitalized. If it is manufactured inventory, instead of the purchase price, you will have direct material, direct labor, overheads can be variable or fixed, but production overheads, usually administrative or selling and distribution overheads, are not taken to be a part of your cost of the inventory. And it is possible that your inventory is a qualifying asset. When you study AS16, it is a qualifying asset which takes a substantial period of time, like you are a shipbuilder building a ship, in which case a borrowing cost attributable should also be capitalized. So all of these would go into the cost of the inventory. While determining cost, one needs to remember that your cost can include normal losses, if any, that are expected. However, abnormal losses will not be forming a part of cost. Admin and selling distribution overheads will usually not form a part of cost, and storage cost will generally not form a part of cost unless the storage cost is necessary in bringing about a desired change in the condition of inventory. Like for example, wine, or for example, a dry fruit. The drying process is a storage cost. However, it kind of brings about the desired change. For dry fruits, you want to sell it in a particular condition. Next, there is a very important concept where there is an interlinkage with costing regarding normal and abnormal loss as well as absorption. So when you look at normal loss, we said that normal loss should be a part of cost. How will that be a part of cost? Well, you will take your total cost and divide it, generally, loosely speaking, by the normal units. However, if there's an abnormal loss, let's say you had ordered 100 units, normally you expect to receive 95, you got only 92, you will divide by the normal units, that is 95, and hence normal loss will automatically form a part of the cost. However, abnormal loss will be taken to the P&L. However, in case there is an abnormal gain, you cannot recognize gain before the sale happening, and hence the standard says that you will record it at the total cost or the divided by the normal units or actual units, whichever is higher. That same principle is kind of carried forward into absorption, where it is possible that you want to find the cost per unit and there is fixed production overheads of 1 lakh rupees. You will have to find the cost per unit. So the fixed production overheads, you will divide it by the budgeted or normal level of output. For example, 1 lakh rupees divided by 10,000 units, that is 10 per unit. However, what if you are manufacturing more or less than normal? That is due to probably an abnormal event, and as a result, if your actual output is less than normal, you expected 10,000, you actually could manufacture only 8,000, in which case you will still calculate your absorption rate as your original absorption rate based on the normal units only. That is 1 lakh divided by 10,000, and hence that is rupees 10 per unit. On the other hand, if your actual is greater than normal, like you manufactured 12,500 units, in which case you will now revise your absorption rate as 1 lakh divided by 12,500, probably around 8 per unit. The principle is still the same. You will take your overheads, your total overheads divided by the normal or actual, whichever is higher. The logic behind both of these is, if for example you can manufacture 12,500 units, you still take the rate based on 10,000. This is 10. Let's assume all the 12,500 units are unsold, in which case if you multiply let us say 10 into 12,500 unsold units, your closing stock will be measured at 1,25,000 when you have actually spent only 1 lakh rupees, let us say, as fixed overheads. In which case, there will be a 25,000 gain, but you cannot recognize a gain before you actually sell it, and hence the standard says, well, you know what, in such a case, we will take 12,500 units. This will be 8 into 12,500, even if they are unsold, will be 1 lakh rupees, and hence there will be no profit, there will be no loss as well, but your cost per unit falls due to economies of scale, that is 8 rupees per unit. In the next year when you sell it, you can recognize again. Then there is a question on joint and buy products, very similar to question 1b, which came, a good question, in your May 2024 exams. Joint products and buy products. Remember, you will calculate the net joint cost, that is the total cost of the materials, joint process costs, etc. Joint cost minus NRV of the scrap or byproducts. Byproducts are those products which you intend to sell, uh, which are manufactured by the way, and you don't intend to sell in the normal course of business, like you want to make petrol and diesel from, let us say, crude oil. By the way, the process is such that along with petrol and diesel, a chemical one also comes out, and hence that chemical one is the byproduct. So your net joint cost for petrol and diesel will be the total cost minus the NRV of the byproduct, and that will give you the net joint cost, let us say, for petrol and diesel, which you will allocate to petrol and diesel in the ratio of the sales value at split off point. The best ratio is to allocate it based on the sales value at split off point. Okay. Net joint cost is calculated as total joint cost minus NRV of the byproducts. Net joint cost will be allocated between the main products in the ratio of sales value at split off point. Then you have cost flow assumptions. This is unique only to inventory, and you don't have such a thing even for, let us say, something like a PP. For inventory, ideally the best method for finding the cost of the inventory sold is the specific identification method. However, that is suitable only for certain businesses like paintings, etc., where you can specifically identify the inventory being sold. However, if inventory units are interchangeable, like you have 100 packets of dairy milk, they are interchangeable, in which case you can follow certain cost flow assumptions like FIFO, first in first out, or weighted average, that is the total cost of opening plus the current year purchases divided by the total opening units plus the current year units, that is a weighted average cost. Remember, LIFO or simple average method is not permitted for the purpose of inventory, at least in India. When you look at other simplifications for certain businesses like manufacturers with a long production history, you can even follow the standard cost method, provided the standard cost reasonably approximates the actual cost. Or for retailers like Hypercity, Star Bazaar, who are selling multiple products, in which case you can even follow the retail sales price method, that is the total selling price minus the gross profit or gross margin that you deduct will give you the notional cost. Remember, these are not mandatory. If you want, you can follow them, otherwise you can very well follow FIFO, weighted average, etc. for companies like DMart as well, okay, which are retailers. Next, you go to the valuation, the last part of the chapter. Valuation of inventory can be finished goods or WIP, happens at the lower of cost, which you calculated earlier, or the net realizable value NRV, which is the estimated selling price minus the estimated selling expenses minus estimated cost to complete. That will give you the NRV cost or NRV, whichever is lower. However, if it is raw materials does not make sense to compare it with NRV because you don't intend to sell the raw materials, and hence ideally raw materials should be valued at cost only. However, if the NRV of the finished goods is less than the cost of the finished goods, that is basically it is a loss making finished good, then the standard believes that, well, if the finished good is loss making, maybe you might not use the raw materials to make that finished good, in which case you will have to sell the raw material, and hence only and only in such case, that is the NRV of the finished goods being less than the cost of the finished good, that is a loss making finished good, you will record the raw materials at the lower of cost or replacement cost, whichever is lower. What do you mean by replacement cost? Well, generally I don't sell raw materials, and hence I don't have the estimated selling price, but I purchase the raw materials. So what is the purchase price? I assume that must be the same as the selling price, and hence called as a replacement cost. It is also possible over here that the NRV might subsequently change, like you have a cost of 100, NRV becomes 80, will write off 20, the carrying value becomes 80, the inventory remains unsold. In the next year, the NRV climbs up to 95 or it becomes 105. Can you reverse the write off earlier done? Yes. Measurement is cost, that is 100, or NRV, that is a 95, or cost, that is 100, or NRV, that is 105, whichever is lower. So if your carrying value is 80, you can always bring it up to 95, or in the second example 100. You can't take it all the way up to 105. So reversal is very much possible. So that takes care of a fairly important standard, I would say, that is AS2. Next we have AS3. Institute also has a separate section over here along with preparation of financial statements, where you have detailed sums regarding cash flow statements. Here we will discuss the general principle of the cash flow statement, which is a core financial statement. So AS3 cash flow statement is a core financial statements, and it needs to be prepared along with the balance sheet, P&L, and not just hidden in the notes to accounts. In the cash flow statement, there is nothing but a vertical presentation of the cash and bank account, where you will segregate the cash flows into three headings. Cash flow from operating activities, that is arising from the day-to-day course of your operations, like sales, purchases, salaries, rent, etc. Cash flow from investing, like cash flows arising from purchase of fixed assets or intangible assets, or sale of fixed assets or intangible assets, or purchase or sale of investments. However, investments also give you interest income or dividend income, which will also be cash flows from investing. In fact, if there are any taxes arising on this investment income, that will also go in cash flow from investing. Similarly, cash flow from financing, this is from the providers or sources of capital, like loans taken, debentures issued, preference shares issued, equity shares issued. All of these will come. At the same time, loans repaid, preference shares redeemed, debentures redeemed, or equity shares bought back will also come over here. Or any payment made to the providers of capital, like dividend paid, interest paid, will also be taken over here as cash flow from financing. So you'll segregate into cash flow from operating, investing, and financing. And at the end, you'll have the net changes in cash and cash equivalents. To that, you will add the opening cash and cash equivalents. That will give you the closing cash and cash equivalents. The cash flow statement should tally. Sir, but what do you mean by cash equivalents? Well, cash equivalents are short-term, highly liquid, marketable instruments, where the term with largely stable values. Like for example, you have treasury bills that are issued by the government, which have a largely stable values and a maturity of only 2 months. So over here, this can be taken as a cash equivalent, but for you to be a cash equivalent, you should have a stable value. So equity shares cannot be a cash equivalent, and your tenure from the date of acquisition to the date of the maturity of the instrument should not be more than 90 days or 3 months. That is when you are a cash equivalent. Okay, so that is about cash and cash equivalents. Cash flow from operations can be prepared using two methods. There is something called as a direct method and the indirect method. What does a direct method mean? Well, you directly find the cash flows. That is, you find the cash collection from debtors, cash sales, cash paid to suppliers, cash purchases, cash paid to employees. This is direct method. That is a much more logical method. These cash flows you can find by, let's say, preparing a sample debtor account, opening debtors from the balance sheet, closing debtors from the balance sheet, credit sales can be taken, and the balancing figure is cash collection from the debtors. Alternatively, you can even show these workings in the bracket. But for using the direct method, you either need the bank account or you need the balance sheet as well as the profit and loss. However, in the question, if the data regarding profit and loss statement is not given, or bank account, for example, is not available, only two balance sheets, opening and closing balance sheets, are given, in which case another method which can also be followed is the indirect method. Now, indirect method is a method which is indirect, that is, it believes that whatever is the net profit should be the cash flow from operations. Net profit usually arises out of operations, and hence net profit should be the cash flow from operations. And hence, under the indirect method, you start at the net profit after tax. If net profit is available, if not available, you can look at the difference between profit and loss, find the reserves, retained earnings, and find whatever is the difference, and that will be the retained earnings during the year, and from that try to find the profit during the year. So if your opening P&L was 100, closing was 120, you can reasonably say that 20, unless given otherwise, must be attributable, let us say, to the profit during the period. Okay, once you do that, well, ideally net profit should be cash flow from operations. However, there are three clear impurities in the net profit. First, non-cash items. Okay, before that you will make it before tax, so net profit is after tax, add back income tax expense, and at the end subtract tax paid, actual tax paid. But within that there are three impurities. First is the non-cash items like depreciation, amortization of intangibles, impairment. All of these are non-cash in nature. You will say that you will add back non-cash expenses because you don't have to pay them, but they have reduced the net profit. So you want to go from net profit to the cash flow from operations. So you will, let us say, add back the non-cash expenses, deduct the non-cash incomes if any. Second is the non-operating items. Sometimes in net profit there might be certain non-operating items like interest paid, which is financing in nature, or interest income, which is investing in nature, or gain or loss on sale of fixed assets, which is investing in nature. We will say that we are trying to find the cash flow from operations, and hence you will reverse this item. So if there is an interest or dividend income, you will deduct it because your net profit is higher. However, your cash flow from operations should not be impacted. So you deduct it from here and then show it as a separate cash flow in your investing section. Third is the most important, that is the working capital or operating assets or liabilities adjustment. Like over here, what happens is we assume that okay, we have removed the non-cash items, we have removed the non-operating items, which means whatever is remaining is a cash flow. Well, provided it is collected, like sales need not entirely be collected. So how will you know whether they are collected or not? You look at the balance sheet, because if there are debtors, like opening debtors were 0, closing debtors are 100, that means whatever is the sales during the year, 100 of those sales were not collected, and hence you will have to make certain adjustments. The general rule that you will remember over here is if there is an increase in current assets, like debtors going from 0 to 100, you will deduct. Opposite effect. Increase in current liabilities, you will add. What is the logic for this? Well, if debtors are going up, that means you must have collected lesser cash, so you deduct. Or if creditors are going up, you have paid lesser cash and hence you add. And hence, just remember the general rule from an exam perspective. At this stage, if there's a current asset, the change is inversely related. An increase in current asset, you will deduct. A decrease in current asset, you will add. But a current liability, you will have a direct relationship. That is, an increase in current liability, you will add. A decrease in current liability, you will deduct. And that will give you cash flow from operations. Remember, your CFO has to be the same whether you follow the direct or the indirect method. CFI and CFF, irrespective of the methods, will be done in the same way. How will we know which method to follow? Ideally, that should be evident from the data in the question. For an indirect method, you need only 2 balance sheets. Even if only 2 balance sheets are there, you can use the indirect method. But if you want to use the direct method, along with those 2 balance sheets, you also need the income statement. But if neither balance sheet nor income statement is given, just a bank account is given, then only direct method is possible. Okay, so you look at the data and then decide which method is possible. That takes care of AS3. Next, you go to accounting standard 4, AS4. This is contingencies and events occurring after the balance sheet date. Largely, a lot of the contingencies are actually discussed in AS29, but nevertheless, most of this standard pertains to the events occurring after the balance sheet date. 2 or 3 important things that you need to remember. First, what is a post balance sheet period? Post balance sheet period starts from after the balance sheet date. Let's say 31st March 24 is your relevant balance sheet date. Post balance sheet period will start from 1st April 24 and will continue till the time the relevant approving authority approves the accounts. The approving authority for a company is the board of directors. And let us say when the board of directors approves the accounts, that is when we say that the post balance sheet period kind of ends. There may be various other dates given to confuse you. The date when accountant prepares the accounts, audit committee approves the accounts, shareholder. Remember, the accounts are signed for and on behalf of the board. So shareholders will just discuss on the accounts. They are not responsible for signing or preparing the accounts. So date when shareholders, you table the accounts in the AGM, file it with SEBI, ROC or someone, all of these dates are relevant. The date when the directors sign in case of a company, or the Karta signs in case of an HUF, or the partners, managing partners sign in case of, let us say, a partnership, is the relevant date. Now, what is the significance of this standard? Now, if let us say the directors are signing on 31st May 2024, so the 2-month period of April and May is a post balance sheet period. Now, there may be so many sales, purchases, things happening during those 2 months. They are happening in the year 24-25, should be recorded in the year 24-25. However, some of these events pertain to conditions existing on the balance sheet date. If they pertain to conditions existing on the balance sheet date, then they are called as adjusting events and hence require adjustments. Like for example, you might have done a credit sale on 1st February 24 with a 3-month credit, and hence you must have recorded a debtor account debit to sales in February 24, that is in the year 23-24. You thought that you will collect the money. However, when you went to the customer's premise on 30th April, when the credit period expired, to collect money, you saw that there was, this customer is kind of a sham. It was a fraud. There is no such customer, and hence you realize that the money is going to go bad. However, you came to know in April the inability or the non-willingness to pay was also there on 31st March. You just were not aware about it, and hence this is an adjusting event which will require you to create a provision for bad debts. Or there was a pending lawsuit, ongoing lawsuit, litigation, on which case you were giving a disclosure as per AS29. However, there is a court case that came, verdict which came in April, which told you that you have to pay 500 rupees, in which case you were trying to estimate how much you have to pay. Now you exactly know how much you have to pay. So that is giving you an additional information of a condition which was already existing on the balance sheet date. Or sometimes a managing director has to be paid. Just a second. Sometimes a managing director has to be paid based on the percentage of net profits. Now on 31st March, profits are accrued, but you don't know how much they are. So in the Post balance sheet period, you finalize the accounts, you say that the profits are 100 crores, 5% of that, that is 5 crores, will go to the managing director. Adjusting event. What do you mean by adjusting events? These are events which happen in the post balance sheet period but give you additional information of a condition existing on the balance sheet date. Things like frauds, errors getting detected in the process of audit during finalization are also adjusting because they pertain to conditions existing on the balance sheet date. An accountant was embezzling, stealing cash. On 31st March, we were not aware, but while finalizing, a talented article clerk like you detected that cash has been stolen. But as a matter of fact, it was also stolen on 31st March. It was not there, and hence we will show the loss by theft on 31st March as well. These are adjusting events. What do you do with adjusting events? Well, as the name goes, you adjust. You will incorporate that in the accounts of the year 23-24. Then you have non-adjusting events. These are new events which arise after the balance sheet date. However, they do not pertain to conditions existing on the balance sheet date. Like there's a fire in April. Well, there was no fire on 31st March. So, what do you do with non-adjusting events? Well, you will merely give a disclosure only if they are material. Remember, there may be hundreds and thousands and lakhs of items happening in April and May. Does not mean every item you disclose. If there is any material item, like let us say a fire, etc., for those material items you will give a disclosure. So, non-adjusting events, to the extent they are material, you will give a disclosure. Exception to adjusting / non-adjusting events, the standard over here says that generally non-adjusting events you just can give a disclosure if it is material. However, if the event is so material that it impacts the going concern assumption, in which case you can treat it as adjusting. If the fire in the post balance sheet period is so significant that it impacts the going concern assumption of the entity, then it can be treated as an adjusting event. A few examples have been discussed regarding adjusting as well as non-adjusting events. As we discussed, a few examples regarding adjusting event. Non-adjusting events can be lost due to fire, earthquake, even an amalgamation or absorption which is agreed in the post balance sheet period is a non-adjusting event, or checks collected after the balance sheet date. Even if the dates on those checks were before the balance sheet date, you have not collected them and hence they are non-adjusting. Fair. Next, you go to the next accounting standard, that is AS5. AS5 has the biggest heading, probably not a very difficult standard, but it has the biggest heading, net profit or loss for the period. Your net profit or loss mein kya hai? You have to figure out in terms of disclosure whether there is ordinary activities or extraordinary activities. What do you mean by extraordinary activities? These are activities which are unusual, infrequent, both. That is, for example, when you look at an extraordinary activity like a lottery winning, it is not usual, nor is it frequent. So it is an extraordinary activity. However, when you sell land, there may be a gain on sale of land. It may be infrequent, but in the business, if you are buying land, sooner or later, some or the other day, you will sell it. So it's not unusual. So extraordinary items, if any, have to be separately disclosed. However, if it is ordinary activities, well, they will be separately disclosed if they are material, like impairment may be material, or loss or gain on sale of land, though not extraordinary. If they are material, you will have to disclose it. So that is regarding net profit for ordinary items, extraordinary items, exceptional, etc. Okay. Prior period items are also there. Prior period items means these are errors, mistakes or omissions that have happened in an earlier period. Like earlier there was a sales invoice which you forgot to record. This was a sales invoice of the year 21-22, 22-23. You are currently in the year 23-24. At that time you forgot to record it. Now those accounts have been finalized. You can't go back and change those accounts, and hence now that it is detected, better late than never. And as a result, you will record it in the current year. However, if you record it in the current year, it does not pertain to sales of the current year, and hence you will separately disclose this as a prior period item, PPI. Okay. Next, you have accounting estimates. So when you look at an accounting estimate, useful life of an asset, salvage value, these are all estimates, and estimates are linked to judgments, and judgments can change. So if there's a change in accounting estimate, it has to be applied prospectively. However, there's a change in accounting policy. Accounting policies are methods of applying accounting principles, like FIFO for inventory or a cost or revaluation model for PP. These are accounting policies. If you change accounting policy, you have to retrospectively restate from the earliest reported date, and if a retrospective restatement is not permissible or not possible, then you have to give a disclosure in the notes on reasons why that retrospective change is not possible. Okay, impracticability would be maybe lack of data, like maybe it is lost due to earthquake, fire, flood, or maybe the accounts have been taken by the governing authorities. You don't have them, and hence you are unable to restate it. Okay, a change in accounting policy, remember, refers to applying a new policy to the same set of transactions. If you enter into a new set of transactions and you apply a new policy, that is not called as a change in accounting policy. By the way, that is called as a new policy applicable to a new set of transactions. For example, you are a real estate dealer, and hence you are a broker, so you are recognizing commission income when the sale gets completed. That is full completion method. However, now you said enough of acting as a broker, I will do my own construction. So you become a contractor and you constructing buildings, in which case you are following construction contracts AS7 and recording revenue as per percentage completion method. Now you cannot say that you are changing accounting policy from full completion to percentage completion. This is different transactions which are accounted for under different policy. A change in accounting policy means the same transaction is accounted for using a different policy. Let us say there is the same item of inventory. Let's say petroleum products, which we were earlier recording using FIFO, you are now deciding to record using weighted average. However, earlier you are a seller of petroleum products, you are recording them using weighted average. Now you discontinue petroleum business, you start a consumer goods business, and you start with FIFO. There is a new method, that is FIFO, for new items of inventory. This is not a change in accounting policy, will not require a retrospective restatement. Are we clear with this? Okay, so that is regarding AS5. Next, you go to AS7. Beach में there was a standard AS6 which was removed. That was a standard on depreciation, got merged with the standard of PP AS10. Similarly, 7 के बाद 8 करके एक standard हुआ करता था, research and development. That was removed. It got merged with AS26. Unfortunately, other than that, every other standard is there. So you will go to AS7. This is a standard on construction contracts. Now 7 and 9 are both standards which largely deal with revenue recognition. So when we look at AS7, what does it include? It includes recognition of revenue for something called as contractors. Now, contractors are entities who are usually engaged in long-term construction contracts, and hence, let's say I have been given a contract to construct a bridge, highway, etc., in which case ideally my revenue should be recognized when the bridge is completed. However, that will take a long period of time, and hence revenue will only be recognized in specific years when the projects are completed. So to bypass that, AS7 comes in and says, well, you know what, for these long-term construction contracts, we will allow you to recognize revenue based on the stage of completion, that is percentage completion method, even if the risk and reward is not transferred, and hence there is a scope exclusion in AS9, revenue recognition, and construction contracts come under AS7. That will be recorded over here. Now there are two types of contracts. There is a fixed price contract where you will be told to construct a bridge for which you will get 1000 crores, or a cost plus contract where you will be told that whatever is the cost that you incur plus 10% is what you will get. Either ways, AS7 will apply. Now AS7 says that you will recognize construction revenue based on what? Well, you will say that depends. So accounting for contract revenue minus contract cost will give you contract profit. So contract revenue will be recorded in case cost and revenue can be reliably estimated. So for a lot of contracts, you can reliably estimate, and the estimates can change, but you can broadly reliably estimate that what will be the cost incurred or what will be the revenue that you will get if you were to complete the contract. If they can be reliably estimated, then you will recognize revenue based on the stage of completion. How do you calculate the stage of completion? Cost incurred till date upon the total estimated cost, that is cost incurred already plus the estimated cost that is yet to be incurred. That will give you the stage of completion. You can either calculate it based on cost incurred data, or maybe there is some physical verification or an architect survey which tells you a percentage completion, you will take that. So revenue should be recognized based on the stage of completion. However, there may be certain contracts which are loss making. So as per AS7, if the contract is loss making, that is the estimated cost of completing the contract, that is 1000 crores, is greater than the revenue that you get from the contract, let us say 800 crores in totality terms, that is there is a 200 crore loss. Prudence and conservatism says that if you are expecting a loss that is going to necessarily happen on account of this contract, why wait for the loss? You recognize the loss, create a provision for loss immediately. So over here, you will recognize revenue always on a percentage completion basis. That is, revenue will be recorded for each year, revenue till date minus revenue earlier recorded will give you the revenue to be recorded in the current year. However, if you cannot reliably estimate the contract cost or revenue, then you can either recognize the revenue based on the cost incurred or wait for the full completion of the contract, in which case revenue recognition can possibly happen. So over here we have given special key points regarding provision to be made for losses. So step 1 in all of these construction contract question will be, you will first figure out whether the contract is overall profitable or overall loss making, because if it is overall loss making, then you will have to create an immediate provision for losses. And if it is a profitable contract, then you will record profit over the period of time, and you will not be recording it immediately. Okay. Second stage of completion, as we said, you record it by cost incurred upon the cost incurred plus the total estimated cost. Cost incurred till date can include the work certified plus work uncertified. So over here, work certified is, let's say you have constructed a building of 5.5 floors. For 5 floors, an architect has given you a certificate that this is the cost incurred for the work that you have completed. For the half a floor, you have still incurred the cost, but architect has not given you any certificate, but you have incurred the cost, and hence your cost incurred till date will be the work certified plus the work uncertified. This will be generally recorded at cost. Work certified and uncertified data given in the question is assumed to be at cost, at least in your accounts paper. Other methods can be survey method, physical completion method, etc. Can the estimated contract revenue as well as estimated contract cost change? Yes, these are accounting estimates and they can very well change, and if they are changing, this is treated as a change in accounting estimate and will not have any retrospective impact. Whatever be the changes will be incorporated prospectively. How do you incorporate the changes? You always calculate the revenue to be recognized as in the current year as revenue till date less revenue earlier recorded. Cost to be recognized as cost till date less cost earlier recorded, and that will give you a correct measurement for revenue or cost to be recorded in a particular year. Now, I might have 20 different contracts. Do I total the cost for all the 20 contracts, revenue for all the 20 contracts? No. I will calculate the stage of completion for each contract separately, and I will do accounting for revenue, profits, etc. for each contract separately, unless the contracts are agreed as a part of a single overall profit margin or a single overall package. Like there were 5 dams that you had to construct, 3 were loss making, 2 were profitable. We said that the 2 profitable contracts are so good that we want to take this project. Now the 3 contracts are loss making, 2 are profitable. However, they are all interconnected, they are part of a single package, and hence we will do the accounting for all the 5 dams together as if it is a single package. In other cases, if you don't have this condition that you have to accept all, here the government says you either accept all or none of them, then you have to account it as a single package. The government never told you that. Let us say in another case, the government said you can take even one contract if you want to. Well, in such a case, you will have to do accounting for each contract separately. You cannot combine the contracts. That is contract revenue basic workings. Largely the standard is the standard on contract revenue. Then you have within contract revenue, you have the agreed price should be a part of contract revenue. Apart from that, there can be certain escalations. Then escalations will also be a part of contract revenue wherever applicable. And there can be performance incentives like a performance bonus. If you complete the bridge in a term of 5 years, we will give you a bonus. However, this is you cannot recognize a bonus till the time you have actually completed the bridge, and hence the standard says till the time it is virtually certain that you will receive the bonus, that is the project is at a sufficiently advanced stage that you are almost there, the project is 95% complete, and that is hardly 3.5 years, so you will almost certainly get the bonus. Before that, you will not record this performance incentives. So if performance incentives are given, you will ignore them till the time you actually complete the contract. And lastly, variation of scope. Earlier you were told to make a 2-lane highway, now you are told to make a 4-lane highway. Now that is variation of scope that will increase the contract revenue, can also possibly increase the contract cost, and hence contract revenue can change due to the fact that your agreed price can change, or there can be escalation, or there can be a performance incentive which now is going to be virtually certainly received, or there can be a variation scope. All of these can be possibly considered. Next, you go to the next relatively less important section, I would say, that is contract cost. These are directly attributable cost which include labor, material, etc. It also includes overheads which are largely production or construction overheads, which will be included as long as they are directly attributable. Usually admin and selling and distribution expenses will not be taken. When you take cost incurred, you will take, for the purpose of stage of completion, you will take the normal cost incurred. If there is any abnormal loss, let's say loss by fire, earthquake, etc., that will be taken to the P&L directly. It will not impact the stage of completion, and it will not even be taken as a direct contract cost. It will be taken as an abnormal loss in the profit and loss account. In terms of disclosure, you will show the contract revenue recognized, the stage of completion, contract cost, contract profit. Apart from that, if there are any progress billings, that is how much bill that you have raised to the customer and collected money. Retentions, you have billed the customer 100, they have paid you only 90, 10 they are retaining, and amount payable or due to the customer if applicable, that disclosure you will kind of show. Next you have AS9. This is the general standard on revenue recognition, where you will recognize revenue on sale of goods or rendering of services or certain utilization of resources. So when should you recognize revenue on sale of goods? When the risk and reward incidental to goods are actually transferred. Just a second, we'll come back to the initial section, but when should you recognize the revenue on sale of goods? When the risk and rewards of the goods are incidental to ownership are actually transferred. And when it comes to rendering of services, when should you recognize revenue? Well, under the full completion method, you will recognize revenue once the service is fully rendered. But in let us say if the service is such like coaching, if we were to recognize revenue, we will recognize revenue as and when service is performed. We will not wait till the full completion of service. So you can either recognize revenue based on proportionate completion method or based on full completion method over here. And lastly, on utilization of resources, like if you have given a loan, you are earning interest, interest will be recognized on a time basis, or you have made an equity investment, then dividend income will be recorded only when the right to receive is established and not merely on a time basis. That is when it is approved by the shareholders in the general meeting, that is when dividend income gets recorded. Lastly, if there is a royalty income based on the agreement, like if I am Domino's and have given a license to Jubilant Foodworks to use as a franchise Domino's name in India, Jubilant pays 10% of whatever sales to me as royalty. I will recognize the royalty income as and when it is accrued. So these are the general principles on revenue recognition. We will do a few special cases, like when you look at revenue recognition, when should you recognize revenue? Sir, when the risk and reward of the goods are transferred, blah blah blah. However, what if you think that the money is not going to be received? Like you have rendered services or given goods, let's say, but you think that the money is not going to be received, in which case, why? Well, because the customer has poor financial condition, or you will not be able to collect money, whatever be the reasons, in which case the standard says then recognizing a sale and debtor and then recognizing a bad debt to such if there is uncertainty in collectability, then you will postpone revenue recognition. Rather than recording revenue and then recording a bad debt, you don't recognize revenue at all. However, at initial recognition, you thought that money will be collected. However, when you made a sale to a customer in Bangladesh, you thought that there will be no problem. However, later as you see, there is a lot of turmoil, let us say as we record this video, in Bangladesh, in which case now you think collecting that money is going to be very difficult. Now you will not reverse the sale already recorded. However, now you can create a provision for bad debt. If there is initial uncertainty in collectability, don't record the sale only. Then there is no need to record a bad debt separately. Sale ही record नहीं हुआ, debtor ही record नहीं हुआ. However, if you have recorded a sale because there was certainty in collectability, but later things happen because of you are not able to collect, then later record a bad debt. Uncertainty can also be on measurement. You don't exactly know how much is going to be the revenue, so you will wait till the time there is certainty in terms of collectability or measurability when you want to recognize revenue. Okay. Next, you have a few special cases, like if there are consignment sales, then you will recognize revenue when the sale happens by the agent. When you transfer it to your agent, that does not matter. When the agent sells it to the third party, that is when you will recognize the revenue. Sale subjected to inspection, you recognize revenue when the inspection is completed. Sale on approval basis, you ideally record when the buyer communicates the approval or buyer does some act through which he cannot reject, or a reasonable period of time has elapsed after which buyer cannot reject. If this is a very important case, Institute asks a lot of questions on this. Revenue recognition when delivery is postponed at the buyer's request. Usually recognize revenue when the ownership of the goods gets transferred. However, sometimes we had decided that in March we will transfer ownership, but the buyer calls up and says, I'm not there, you keep the goods with you till 15th of April and give it to me by 15th April. We say that we'll take basic care of these goods, but if something happens, it is under your risk. The seller agrees, the buyer agrees, and hence in such a case, even if the possession is not transferred, if the ownership of the goods is transferred, you can recognize revenue even if the possession is still with the so-called seller. Insurance agent commission will be recognized from the effective date of the policy. Sales and repurchase, it's a very interesting thing over here, where let us say you have X which is selling 100 TV sets of rupees 100 each to buy. X agrees to repurchase the same on by the end of the year at 110. Now, why am I selling at 100 and agreeing to buy at 110? Well, probably I need money. Y is ready to give me the money. However, he needs security. So I'm giving my inventory, that is television sets, as a security. Now, rather than entering into all of this complicated paperwork, I said that I will show it as a sale, and 1 year later I will show it as a repurchase. So you want a 10 rupee interest, I will show it as a sale of 100 and I'll buy it back at 110. So in essence, this transaction is not a sale or not a repurchase, it is actually a loan and a repayment of loan. And as a result, you will pass the entry bank account debit to loan 100, during the year interest account debit to loan 10, and then at the end of the year loan account debit to bank 110. Okay, next we have discounts. As you are aware, trade discounts you reduce from the sale price and record net. Cash discount you show separately in the P&L. Cash discount is defined as a discount linked to early payment, whereas trade discount is defined as every other discount other than cash discount is defined as a trade discount. Okay, there may be a few questions pertaining to price revisions. That is, let us say you have sold goods in the year 2010, 11, 12, 15, 20. For the last 10 years you have been selling goods. However, in the year 2021, you have decided to revise price retrospectively. Now, the customer also agrees that yes, price should be revised retrospectively for whatever reasons. In which case, can you go back and change the revenues already recorded in the past? No. You will not change the revenue already recorded in the past. However, you will make an adjustment for the price changes in the year 2021 to give effect to that price change. So, for example, you are selling goods at the rate of 10. You sold 100 units each year, that is 1000 K sales were booked in the last 10 years. Now, you say no, both seller and buyer agreed that retrospectively the price should be 10.5. So, the additional 0.5 into 1000 units sold for the last 10 years, that is 10,000 units into 0.5. That comes to probably 5,000 rupees will be the cumulative impact which will be directly recorded in the year 2021 with the detailed disclosure of reasons for the same. You can't retrospectively restate it. Sorry, was this an error? No. Is it a change in accounting policy? No. It is a new fact, new circumstance which is aroused in 2021 and hence should be recorded in 2021 only. Last is property sales transactions. As per the Transfer of Property Act of I think 18 something, I don't remember the year, you don't even need to remember it. In a property transaction, generally registration is necessary. However, even if you have not registered, this will still be considered to be a sale. I am in the books of the builder. The buyer and the builder have not registered the sale with the registrar. Still, it will be considered as a sale. If there is a written sale deed, the possession is transferred and the consideration has been paid or has been agreed to be paid, in which case you will be recording this transaction as a sale irrespective of the fact that registration of the property has not happened. These are just special cases in case you get a specific case regarding the sale. That takes care of AS9. Next you go to AS10. Now this is a standard on property, plant and equipment. It's a fairly interesting standard. First, what will be covered under PP? Well, PP covers items which are tangible. That is, they have physical form, you can touch, feel, see. Second, held for the purpose of use, not for the purpose of sale. Use can be administrative use, selling and distribution, employee welfare, whatever, pollution control, use in the ordinary course of business. And third, it has a life at or beyond 12 months. So what is not covered under PP? Well, items which are held for the purpose of sale in the ordinary course of business will not be PP, they will rather be treated as inventory. Or there can be, let us say, certain mineral resources, etc. There's a separate accounting guidance given for the same and hence they will be not recorded. Mines, depleting assets will be having a separate accounting guidance. So this will not be accounted as per AS 10. Now there is something called as living assets, biological assets. Now living assets can have living plants or living animals. Living plants are further subdivided between bearer plants and non-bearer plants. Animals, there is no such segregation. Animals will not generally be covered by AS10. There is separate accounting guidance for living animals like cattle. If I am Amul and I have cattle with me as inventory, there is a separate guidance for livestock. Accounting will be done based on that. Even living plants, there are two types of plants. There is bearer plants and other than bearer plants. Bearer plants are plants which bear agricultural produce and are not produced themselves. Like for example, a coconut tree bears coconuts and hence it is a bearer plant, it bears produce. Whereas if you look at, for example, a bamboo tree, it itself is a produce. So a bamboo tree will be covered under a separate accounting guidance. However, bearer plants for you, institute does not ask you as much about bearer other than bearer, etc. But from an exam perspective, biological assets for agricultural activities, living animals, always outside AS10, living plants, if they are bearer plants, they are within AS10, other than bearer plants are outside AS10. So chalo, let us focus on what is a bearer plant. Bearer plant is a plant which bears agricultural produce and is not produce itself, like for example a mango tree, coconut tree, etc., apple tree. Second, its life is at or beyond 12 months. Like most of these plants have a life of beyond 12 months, the examples we discussed, and hence they are bearer plants. Usually fruit plantations, cash crops like coffee, tea, rubber will be taken as bearer plants unless the question tells you. You don't have to be a zoology or a biology expert here. The question will tell you in general if it comes. Okay, so these are bearer plants. Stores and spares, also there is some guidance that stores and spares, if they have a life of more than 12 months, they will be treated along, similar to PPE principles. If they have a life of less than 12 months, they will be treated along with inventory principles. So this is a basic introduction. I would not really say that it is very important. The important part of the standard starts from now. What do you include within initial recognition of PPE? Initial recognition of a purchased asset, same as inventory. Purchase price, non-refundable, non-creditable taxes, directly attributable expenses to bring the asset in the ready to use condition. All of these will be capitalized. If it is your own self-constructed asset, material, labor, direct expenses, variable and fixed production overheads will be taken. If it takes a substantial period of time, that is, it is a qualifying asset, even the borrowing cost will be capitalized. Exactly same principles. But the standard gives you some additional guidance. It says what is clearly not going to be taken as a directly attributable expense. First, inauguration expenses will not be directly attributable. Second, expenses or losses after the asset is ready for use will not be added. Third, employee training expenses. The asset is ready for use. Your employees don't know how to use it. You cannot capitalize training cost along with the asset. Employee training expenses. And relocation or retraining. Well, you look at relocation. Relocation means the asset is already in the location and condition is decided. Then you can do an entire Bharat Darshan of that asset. Does not mean you keep on capitalizing the cost every time. No. 4 items the standard very clearly says will not be taken as directly attributable expenses. Inauguration expenses, losses or expenses after the asset is ready for use, employee training as well as relocation, they will not be taken as directly attributable expenses. Apart from that, obviously administrative and selling and distribution expenses are not to be taken as a part of the cost of the asset. If there is any income that is earned during the period of construction, if it is directly attributable income, like you do some testing and you get some product, you sell the product, that is directly attributable, you reduce it from the testing cost and the net amount can be capitalized. However, if it has no direct connection with let us say the asset being ready for use, like for example, there is a under construction building, Rohit Shetty comes and says, I want to use this site for my movie direction. Villain is in an under construction building. Well, I earn some income, but it has no direct connection to getting my asset in the ready to use condition. That income will go to the P&L. Directly attributable incomes will be deducted and net cost will be taken. Incomes which are not directly attributable, like this renting of place, will be taken to the P&L directly. Now there is something called as a site restoration obligation. What does this mean? This is a very interesting case, also has some impact in AS 29. Sometimes what happens is when you start constructing the asset, the government says, like you are building a nuclear plant, the government says that, well, this is a very sensitive asset, so at the end of the life you are under an obligation to dismantle it and restore the site in the location and condition it was when you took it. So over here, when you buy the asset, you are under an obligation later to dismantle it. So the standard says the obligation to dismantle arises the moment you construct the asset. You will discharge the obligation later at the end, but the obligation, the birth of the obligation is because you decided to construct the asset, you have no option but to dismantle it, and hence in your initial cost, apart from all of these standard things, you will also add the present value of site restoration obligation. So if you believe that 50 rupees will be spent after 10 years, whose present value today is 20 rupees, you will record, apart from these regular costs, you will record asset account debit another 20 to a provision for site restoration another 20. How that provision for site restoration changes is generally not there in your CA inter syllabus, but that provision will slowly go from 20 to 50. This is called as unwinding. And that amount like asset depreciates and becomes 0. This unwinds and goes from 20 to 50. This is unwinding cost, goes as finance cost in the PL, just for your knowledge. Okay, losses like we studied for inventory, normal loss will be added, abnormal loss will be taken to the profit and loss account. A few special cases can include barter or deferred payment. What does deferred payment mean? AS10 believes that if the payment terms are at or beyond 12 months, there is a hidden period. No one gives you credit at or beyond 12 months without charging you interest. And hence, if they are telling you pay me 240 rupees after 2 years, we will say 240 after 2 years is equivalent to how much today in present value basis. So you will take the cash price equivalent or the present value, and that will be taken as your cost of the asset. Let's say that present value comes to 20 rupees. Then the 4 rupees, sir, I have to pay 24. So asset account debit to payable 20. Then each year interest, loosely speaking, interest account debit to payable 2 rupees first year, again interest account debit to payable 2 rupees second year. So your payable slowly reaches up to 24, and then 2 years later payable account debit 24 to bank 24. That is in case payments are deferred at or beyond 12 months. But if the payments are within 12 months, generally within normal credit, there is no interest unless it is specifically given. So if someone gives you a 2 or a 3 month credit, I don't need to do time value adjustment. If I have to pay 20 rupees after 2 months, well, I will say purchase asset account debit to payable 20, and then after 2 months payable account debit to bank 20. So when will I do the present value adjustment? Only if the time gap between the date when you are acquiring the asset and when you are making the payment is more than or equal to 12 months. Next is barter. Barter can have two possibilities: lacking commercial substance or having commercial substance. What do you mean by having commercial substance? Like a genuine barter. You are giving up a car and taking a land. That's a genuine barter. Whereas lacking substance means you are giving up a Wagoner, you are also taking back a similar Wagoner. So this is a barter on paper because the position of the entity pre and post the barter remains the same. So how do you account for the barter? If it has substance, that is a genuine barter, unless given otherwise, we'll assume that the barter is genuine. We will record the asset that you are receiving at the fair value of the asset given up, that is the first preference. If not available, fair value of the asset received, second preference. And if both of them are not available, then third preference, WDV of the asset given up. Sir, why we take first preference as fair value of asset given up? Because we are doing recognition based on cost. Cost is what you are paying. You might be getting an asset, but for that, if you have to pay cash of 100, that is the cost of the asset. Here, instead of cash of 100, you are giving land of 100. So what you are paying for the asset is 100 rupees worth of land, and hence that should be taken as the cost of your asset. Okay, so that is regarding barter. You can possibly be getting MCQs or descriptive questions regarding this barter. It is quite interesting. Lacking or having commercial substance, as we discussed, if the entity is in the same position both before and after the barter, it lacks substance. Other cases where the some position of the entity changes. Earlier you were paying a driver salary, now you are paying for gardener, something has to change. Then it's a genuine barter, in which case you will remember the rules. However, if the barter lacks commercial substance, question tells you that, in which case you will record the asset that is received at the WDV of the asset given up. Because it is a barter on paper, we will not bring in the fair valuation anywhere over here. Okay. Next, you go to subsequent expenditure. Subsequent expenditure is expenditure after initial recognition. If this is a regular repair and maintenance expenditure which does not increase the life or efficiency, it will go to the P&L account directly. However, if it increases the life or efficiency beyond what is originally assessed, then you are allowed to capitalize it. An interesting adjustment over here would be regarding major replacement, major inspection or major overhaul. In this case, if it is major, and the question will kind of guide you for that, like a new part is obtained, then you will add the cost of the new part, but at the same time you will have to subtract the WDV of the old part. How do you find the WDV? Well, based on the invoice, if I get a breakup, if no breakup, based on the fair value, if available, or the third and the most common thing that comes is you take the notional cost of the new part as a proxy for the old part. So if the new part today is costing you 40 rupees, then 4 years earlier it must have costed how much? You will find the time value adjusted amount 4 years back. Let us say it comes to around 30 rupees. So in your total asset of 100, 30 was attributable to the old part, 100 gets depreciated, the 30 also gets depreciated, and thereby you will somehow find the WDV of the old part. So this is an interesting adjustment for major replacement. I would rate this as important. Next, we look at subsequent valuation at each balance sheet date. Subsequent valuation can be done at each balance sheet date by using the cost model, that is, take the historical cost minus accumulated depreciation or accumulated impairment as the case may be, or it can be done using the revaluation model, in which case you will take the fair value. But when do you find the fair values? Well, fair values can be taken at sufficient intervals. Sufficient intervals have not been specifically defined, but if assets have volatile values, then you will have to do revaluation annually. If they have largely stable values, then you can do revaluation every 3 to 5 years. Okay, but which model can I follow? Well, can I follow cost model for some of them, revaluation for some of them? Well, you have to follow a uniform model for a class of assets. A class of assets have been defined to be assets having a similar nature and end use. Like, for example, if I have 10 plots of agricultural land, they are having similar nature and end use. However, they have a different nature and end use as compared to, let's say, 10 cars that I own, and hence cars I can value using the cost model. Agricultural land I can follow using the revaluation model, but within agricultural land I cannot follow 4 agricultural land using cost model, 6 agricultural revaluation. That is not permissible. However, within that land, if 4 of plots are agriculture and remaining 6 plots are urban commercial, well, they are different nature and end use, and hence different models can be followed. So basically you can follow different valuation models for different classes of PP. However, within a class of PP, you will have to follow the uniform model only. If you follow the revaluation model, revaluation has to be done at sufficient intervals, which can be annual or at max 3 to 5 years. What if you follow revaluation model and there's an upward revaluation, asset goes from 100 to 150? If there's an upward revaluation, initially it will go to the revaluation surplus. However, what if there's an initial downward revaluation, it goes from 100 to 80, then the downward revaluation as per prudence will go to the P&L. Okay, let's say there was an initial upward, you went from 100 to 150, you took the 50 rupees to the revaluation surplus, and 150 is the value of the asset. Later, the asset falls from 150 to 80, in which case there's a 70 rupees subsequent downward revaluation that will first be adjusted against the revaluation reserve, and excess 20 will be taken to the P&L. The contrary happens in the second example. You went from 100 to 80, that's 20 you took the P&L, and then suddenly from 80 to 150 in the second year, in which case 70 will be an increase. First you will again adjust the P&L, and excess 50 will go to the revaluation surplus. What do you do with the balance in the revaluation reserve? You can keep it as it is, or you can transfer it to retained earnings in the ratio of depreciation. Remember, the transfer from retained earnings, transfer in the ratio of depreciation is not mandatory. You can do that over the life, because you said that, well, this revaluation is on an asset, the asset is getting depreciated, so let the revaluation reserve also be written off. Some people might say, I don't want to write off the revaluation reserve. Okay, eventually sooner or later the asset will be sold. When it is sold, then well, you will calculate the gain or loss, but then the balance in the revaluation surplus will be transferred directly to retained earnings. Remember, you cannot transfer it to the statement of the profit and loss. Okay, next there is some revaluation in case the entity follows the accumulated depreciation method. So over here, if you have an asset of 100 with accumulated depreciation of 60 and WDV of 40, now that gets revalued, let us say, to 60, in which case there is a 50% increase in fair value from 40 to 60. So you will credit the revaluation surplus by 20, but what will you debit? Well, there are two methods. You can either proportionately adjust the value of the asset, that is, you can say that if 40 becomes 60, then 100 becomes how much, 60 becomes how much, and you can find proportionately your asset at original cost being 150 and accumulated depreciation going up to, let us say, 90. So asset account debit 50 rupees to accumulated depreciation 30 rupees to, let us say, revaluation surplus 20. Or we can say that let us remove this root of the problem, that you have accumulated depreciation, you remove the accumulated depreciation. Accumulated depreciation account debit to PP 60 rupees. So your asset which was 100 minus 60 will now come to 40 rupees, and now 40 se leke 20 rupees of upward revaluation. So two methods. First, you can either proportionately adjust, or second, you can directly adjust. Whatever you are comfortable, you can pick up depending on the data available. In the last section of AS10 would be depreciation. Depreciation arises from passage of time, obsolescence, wear and tear, etc. The methods of depreciation have not been prescribed, but usually SLM is the most popular, followed by the WDV, but there can be other methods as well, like units of production method, etc., which is possible. The usual ingredients for depreciation involve useful life, salvage value, which are accounting estimates. Management is required to check for these estimates at an annual basis, and if they are valid, well and good. Otherwise, management can change those estimates, which is treated as a change in accounting estimate. to be prospectively applied. Further, the method of depreciation, that is SLM or WDV, is based on the pattern of usage, the pattern of consumption. If you believe that the pattern of consumption is uniform, straight line, in which case the benefits are going to be obtained straight line, you can take SLM. Or if you believe like technological products, you will get more benefit when the technology is latest, follow the WDV method. But can you change the method of depreciation? Yes. If your estimate of the pattern of benefits changes, that is when you can change the method of depreciation, and hence this estimate of the pattern of benefits, let us say we say that if it changes, this is a change in accounting estimate. Remember, a change in the method of depreciation from SLM to WDV or WDV to SLM or any other method vice versa is going to be treated as a change in accounting estimate to be applied for prospectively and not retrospective application. Okay. Also, there is something called as a component method of depreciation. What do you mean by component method? If your asset has major components, like you buy a furnished flat by paying 330 rupees, your asset has major components, the flat as well as the furniture. 30 rupees for example is the furniture, 300 rupees is the flat. Then you will depreciate based on the life of the component. 30 rupees, furniture has only a 10-year life, flat has a 50-year life. So your depreciation will be based on the component method, based on the life of the components. So over here, component method is mandatory if your asset has major components whose lives are different from the life of the main asset, like the life of the furniture is different from the life of the underlying unfurnished flat. Okay, so that takes care of the first set of accounting standards. Now first set means we have done from 1 to 10, let us say, then let's say 11 to 20, and then 21 to 29 and so on. So let us say we go to the second set of standards, which is starting with AS11, foreign exchange. So when we look at foreign exchange, a few key terms over here. First is, what is a monetary item? A monetary item refers to an item which has a fixed or a determinable money value that is to be paid. Like for example, if you look at debtors, you have to pay them exactly a particular, you have to receive an exact amount. Creditors, an exact amount to be paid. So is the case with loan given, loan taken, etc. These are monetary items. Non-monetary items do not have a contractually fixed or determinable amount, like land, intangibles, patents, even inventory for that matter. You don't know exactly at what amount it is going to sell and what amount it is going to fetch you, and hence these are called as non-monetary items. So to detect monetary and non-monetary is a fairly important assessment, because different exchange rates are applicable depending on whether you are monetary or non-monetary. Now the relevant rate, historical rate is to be the rate on the date of the transaction, whereas closing rate is the rate prevailing as on the date of the balance sheet. So how do you record a foreign exchange transaction? At initial recognition, you will record it based on the spot rate which is existing as on the date of the transaction. However, at each balance sheet date, if it is a monetary item, you will restate it to the closing rate. If it is a non-monetary item, you will generally keep it at the historical rate, unless the non-monetary item has to be remeasured. If the non-monetary item has to be remeasured, you will take the rate on the date of the remeasurement. So this is the general principle in case of foreign exchange. A very special case over here is pertaining to para 46A of AS11, which pertains to a long-term loan. So loans are actually monetary items. Foreign exchange gain or loss, them on default should go to the P&L. However, AS used to give a choice where it would say that if you don't want to record the entire loss for these loans in the P&L immediately, you can either record it into a separate account called as FCMI TDA account, foreign currency monetary item translation difference account, and defer it over the tenure of the loan if it is a general purpose loan, or capitalize it along with the fixed asset if it is for a depreciable asset, and then depreciate it over the tenure. So this would be taken as, let us say, the special case for FCMI TDA. Now you have a foreign currency translation. What we discussed till now pertains to transactions where there is an import of goods, export of goods, loan taken, loan given, etc. However, what if you have a foreign branch? What if you have a foreign subsidiary? In which case, at what rates will you translate their trial balance to prepare your full and final balance sheet? Here the standard gives you certain guidance. In case of a foreign currency translation, depending on whether your branch or an operation is an integral or a non-integral. What do you mean by integral branch? It is fully dependent on the parent. For all of its financing needs, it is dependent on the parent, whereas an independent branch is something where it is largely independent. It has a capability to finance its own cash flows, and hence such a branch is called as an independent branch. So in case of an integral operation, it is treated as an extension of the parent, and hence the same rates as applicable over here would apply over here. Like incomes and expenses would be converted at the rate on the date of transaction, and if that is not there, then on the average rate. Non-monetary items at the historical rate, generally monetary items at the closing rate. If there is any gain or loss arising on account of these transactions, it will be taken to the profit and loss account. However, if it is a non-integral branch, then in case of a non-integral branch, you will record your incomes and expenses again at the rate on the date of transaction, if not available at the average rate. However, all monetary as well as non-monetary items will be converted at the closing rate. Even non-monetary items will be translated at the closing rate, and this is where there is some confusion in the minds of students. Sir, when will we take for non-monetary historic? When will we take closing? Well, if you are doing a transaction like you are buying a plot of land, you are an Indian company buying a land in New York, that is a foreign currency transaction, you will record it at the historic rate in general. However, if you have a subsidiary in New York and that subsidiary in New York has in its trial balance and its balance sheet a plot of land, and that's an independent subsidiary, and you want to just translate, then you will translate at the closing rate. These are two separate things that you have to get clear in your mind. When you go to the branch accounting chapter, in the branch accounting chapter, this can possibly also come. What if there's a gain or loss? Gain or loss will go into the foreign currency translation reserve, FCTR, and that is a separate reserve, will remain in the FCTR till the time you dispose of the foreign operation. When you dispose of the foreign operation, like Tata Motors has JLR, it disposes of JLR, then the FCTR attributable to that will then be transferred to the profit and loss account. Till that time, whatever is a gain or loss will be accumulated in the FCTR account only. Sometimes there might be goods sent to branch or goods received from HO. These would be recorded at the corresponding rates because they have to be eliminated, they have to be knocked out. So the rate at which the goods sent to branch have been recorded in the HO's books, that same will be recorded for the purpose of translation in the branch's books. Okay, then there is a separate section on forward contracts for hedging as well as speculation. Speculation is a slightly more easier one. Most of the institute's problems are pertaining to that. What does hedging mean? Hedging means risk reduction. Speculation means you are not an importer or exporter. You think that you will enter into a forward contract. What is a forward contract? It is a contract to agree to buy or sell the dollars at a predefined rate at a predefined date. You want to do this buy or sell because you believe that you are getting the dollars at 50, you can sell it at 55 for example, and hence in such a case what will you do? Well, when you enter into the forward contract there will be nothing. However, at each balance sheet date you will compare your contract's price. For example, you have agreed to buy at 50 with the prevailing price of a similar contract on the balance sheet date, let's say it is 52, then there is a 2 rupees gain. Simple as it gets. Called as mark to market. You compare your contract's price with the price of a similar contract as on the balance sheet date and find the gain or loss. You agreed to buy at 50, now the rate is 48, well there's a 2 rupee loss. You agreed to buy at 50, now the rate is 52, there's a 2 rupee gain. Now that is the case of speculation. Hedging is a little complicated. Institutes problems usually don't have that, but for academic completion we have given over here. To ensure lesser confusion, we are not really discussing regarding hedging right now. Though for hedging you will try to mirror the gain or loss on the underlying transaction. So you might have imported goods and hence there are creditors. So whatever is the loss on the creditors will be reversed by hedging. So the valuation of the forward contract will be the loss on the creditors which is avoided is taken to be the gain for the purpose of hedging in case of a forward contract. That is AS11. Next you go to AS12, which is on government grants. Now for this standard to apply, there has to be a grant, that is something which is quantifiable in money value terms, not merely an assistance. A grant is quantifiable like a subsidy, and second, it has to be from the government. Government can be local, state, national, international, any government, but a government grant will be covered over here. What is not covered in the standard is direct equity investments or loans given by the government will not be covered over here because subsidies are non-returnable. Loans have to be returned. Equity investment, you have to give dividend, etc. So over here, this standard applies to grants. Now grants over here, when do you recognize the grants? Let us say a subsidy. You are buying an electrical car, the government gives you a grant, a subsidy. When do you recognize? Well, you will recognize a grant when it becomes receivable. And if there are conditions attached, it is reasonably certain that the conditions will be fulfilled. You don't need to wait till the fulfillment of conditions. You don't need to wait till the time of actual receipt of grant. Now there are three types of government grants. Specific grant linked to acquisition or purchase of a specific asset, revenue grant linked to income or expenses, and last is a grant nature of promoter's contribution, which is lump sum grant. For example, in order to encourage you to set up a plant in a backward area. Accounting for each of these grants, first you look at the monetary grant, specific grant, that is to acquire a asset. For example, you want to buy a electrical vehicle for 300 rupees, the government gives you a subsidy of 200 rupees. In which case, what will you do? You have two options. You can either reduce that 200 from the cost of the asset and record 300 minus 200, that is 100 net, and then depreciate the 100 over the remaining, let's say 10 years. That is 10 per annum. Or you can show the asset, that is a car, at 300, show a deferred grant, let us say at 200, depreciate the car over 10 years, that is 30 each year, and then the grant, that is 200 divided by 10, that is 20 in each year, will be shown. So this is how you will account for, let us say, a grant which is in the form of let us say, a monetary grant. If it is non-monetary, the government will directly give you the asset at 100 rupees only, in which case you will show the asset account as 100 to, let us say, bank over here. Sometimes the asset is obtained free of cost, in which case the standard says that you will record the asset at something called as a nominal value. Nominal value is a value for namesake, just for namesake. That is called as a nominal value, which is usually 1 rupee, 10 rupees, etc. However, sometimes what might happen is you might receive land, or you might receive a grant for land. Now the thing is, you will say that if you follow the method of showing the grant in the deferred grant account, then the balance in the deferred grant account is going to be deferred in the ratio of depreciation. However, land does not get depreciated, and hence in such a case, if you have a grant for a land worth 300, you get a 200 rupees grant, you decide to show the land at 300 and a deferred grant at 200, land will not be depreciated, and hence you will not be able to defer in the ratio of depreciation. In such a case, you will take the amount into the capital reserve. The 200 rupees will be taken into the capital reserve because land is not going to be depreciated. That is what the standard kind of guides you. So there are quite a few adjustments for that. Next you have, so this is what we discussed about land, for example. Other grants can be in the nature of revenue grants. Revenue grants may be, let us say, grants in order to encourage entities to sell at a lower price. The government says that you are going to sell cylinders at 500 rupees, you sell it at 300 rupees, I will give you 200 rupees. That is not a grant to acquire a specific asset, but that is a grant for subsidizing, let us say, an income or an expense, in which case you can either show the grant in the P&L account when as an income, when, let us say, the sales do happen, or you can sorry, or sometimes a grant is for meeting expenses. You can even deduct it from expenses. So you want the employees to be trained. So you have told organizations that we are giving you grant, you train your employees, so you can even reduce it from the training expenses. The general rule is revenue based grants, you will record the grant in the P&L when the corresponding item goes to the P&L. So if it is for training, when the training goes to the P&L. If it is for sales, when the sales go to the P&L. But sometimes the grants are given for past losses, in which case you can record it to the P&L immediately because the loss has already been recorded in the P&L. And then there is grant in the nature of promoters contribution. So let us say you want to set up a factory in Arunachal Pradesh. The government of Arunachal Pradesh wants to encourage you, and the government says that if you set up a business here on rented basis, owned basis, whatever, we will give you a flat 5 lakh amount. Now that is a grant in the nature of promoters contribution. That 5 lakh you can use for whatever purpose you want, and hence the standard says that grant will be taken into the capital reserve, not in the P&L, not in deferred grant, not reduced from asset, directly taken to the capital reserve. Okay, next there is a possibility of a refund of a government grant. If the government grant has to be refunded, then something account debit to bank. Well, if it was a grant linked to asset and you reduce it from the value of the asset, then the refund will also be adjusted from the asset account debit to bank. However, if it was a deferred grant, you had taken 200 rupees in the deferred grant, but remember that 200 will be deferred in the ratio of depreciation. Then when you refund it, something account debit to bank, you will first adjust it from the balance in the deferred grant, excess if any will go to the P&L account. Same in case of income linked grants, revenue grants. If the grant has already gone to the P&L account, then the refund will be adjusted against P&L. However, if some grant is lying in the deferred grant account, you will first adjust from the balance in the deferred grant, excess if any will go to the P&L. If it was a grant in the nature of promoters contribution, must have gone to the capital reserve, adjust it against the capital reserve. That is regarding refund of government grants. That is AS 12. Next is AS 13, which is on investment, where institute asks you even detailed problems. So like cash flow statement, I recommend you refer the detailed problems. Investment also possible, refer detailed problems. So when you look at investments, AS 13, over here the standard segregates investments into two categories: current investments, long-term investments. Current investments are those investments which are acquired with the intention of disposing them off in a period of 12 months. The valuation for current investments is usually done initial recognition happens at cost and subsequently at cost or fair value, whichever is lower. Long-term investments are defined as investments other than current investments, in which case your measurement base is cost only, less permanent decrease in value if any. So whether a decrease is permanent or not is subjective. Like an entity lost a major let us say patent that it was holding in a lawsuit that reduces its cash flow in the long run, that is a permanent diminution or decrease in value, and hence you will write it off. However, if it's day-to-day market movements, we will not touch the long-term investment, you will show it as cost only. So there are two types of investments: current investments, which are held with the intention of holding it and disposing it within 12 months period, and long-term investments. Every investment other than a current investment is defined as a long-term investment. For investments as well, initial recognition, whether it is current or long-term, will happen at cost, and cost will include purchase price plus directly attributable expenses, like for example brokerage, or non-refundable non-creditable taxes like STD for example, and that will be the cost. Subsequent recognition, as we said, at each balance sheet date would be based on current is cost or market value, whichever is lower. And when you look at, let us say, long term, just a second, and when you look at long term, it is cost less a permanent reduction in value. Okay, I think my battery is a little low for my pencil, just a second. Yeah, so we were discussing about long term investments, which can be measured at cost less provision for permanent reduction in value. That will give you the carrying value. Now, where does the gain or loss on the sale of investment go? Sir, the gain or loss on sale of investment will go to the profit and loss account. Now, how do you calculate the gain or loss? Well, that is selling price minus cost price. Selling price is the price at which you sell it, but the cost. Now, the problem is you might have built up investment over the years. You bought 100 shares of Reliance, then 50 at another price, and 250 at another price. So, at what will be the cost of the investment? You will not know exactly which shares are sold. So, here the standard allows you to calculate cost using weighted average method only. Remember, FIFO is not permitted over here. Like in inventory, it was permitted. Here, FIFO is not permitted. You will have to take the weighted average method if you have to find the cost. So, that is regarding gain on sale. If there is income on investment can be in the form of dividend, it can be in the form of interest. We will be recording it in the profit and loss account for the period where it pertains to you. Like for example, when you look at dividend, you will record dividend income when the right to receive is established. Interest will be recorded on a time basis. A special case might come in case of renouncement of rights, where if you were to renounce rights, typically the gain on renouncement of rights will go to the profit and loss account. The challenge in this particular case is in case there is something what is a pre-acquisition dividend. Like if you were to acquire the share on a cum dividend basis, that is you were to pay, let us say 120 rupees, 100 for the share, X dividend plus 20 for the dividend, and let's say a few months back later you get some dividend of 20 rupees. So typically we say dividend income should go to the P&L account. However, this is pre-acquisition dividend and hence you will reduce it from the cost. So 120 minus 20 and hence net 100 will be the cost. Same is the case with interest. If you purchase bonds on a cum interest basis, let's say interest dates are 31st December and 30th June, you purchase it in, let us say, March. So the first 2 or 3 months of interest you must have paid for when you acquired the bond, and hence when you earn the 6 monthly interest, the first 2 or 3 months of interest will be reduced from the cost because it is pre-acquisition interest, and the remaining will go to the P&L account. So over here, pre-acquisition amount will be reduced from cost, whereas post-acquisition amount will be credited to P&L account. So this is something which is important. Now there may be small cases where there may be questions involving reclassification, that is you are changing your classification from current to, let us say, long term, or long term to current. In such a case the reclassification happens at the carrying value. Whatever is the carrying value, there is lower of cost or fair market value because it was current earlier, or long term lower of cost, or whatever is the carrying value, that is less permanent division if any, will be the base for the new investment. Okay, next between these technically you have an AS 14 for which there is a huge dedicated chapter on amalgamation, absorption and internal reconstruction. I will probably just discuss in brief over here because it is like a separate chapter which requires a separate chapter level discussion. But before you do AS 15, let us say if I were to briefly discuss about AS 14, you cover amalgamation, absorption as well as external reconstruction over here. If it is amalgamation in nature of purchase, you take over assets and liabilities at fair values. The difference between the purchase consideration and net assets will be taken into goodwill or capital reserve. However, if it is amalgamation in nature of merger, when is it in the nature of merger? If, let us say, assets and liabilities are taken over at book values, 90% of shareholders remaining the same, PC is issued in the form of shares and the relative shareholding remains the same, business remains the same, all of this happens, then it is taken as amalgamation in nature of merger, in which case pooling of interest method applies, in which case you take over assets and liabilities at book values, you also take over the reserves in the same form, and the difference, if any, will be adjusted against the reserve. There will be no goodwill that is created. In simplified and a very compact form, if I were to discuss AS14, but having said that, for AS14 as well as for AS21 consolidation, we need a separate discussion and not just a standard level discussion. You will generally have a separate full-fledged 14-mark question generally for amalgamation and consolidation, which will require a lot of solving. Okay, next you go to AS15, which is on employee benefits. Now this is a recent entrant into your syllabus. Earlier in the older syllabus, AS15 was not there because of the sheer complexity it has. But now let us say if it is there and you get an exam question, how do you tackle it? So first of all, what does this standard cover? Under AS15, you have something called as employee benefits. What employee benefits are covered over here? Well, all types of employee benefits except for share-based payment, because there's a separate guidance note like ESOP for the same. So there are 4 types of employee benefits: short-term benefits, which are benefits which are payable within 12 months; post-employment benefits, which are benefits which are payable at or after retirement, like for example gratuity, pension, provident fund, etc. Termination benefits, which are payable at the time of termination, voluntarily like VRS, or involuntarily like, let us say, a retrenchment that you are firing. And then last is other long-term benefits. Other long-term benefits like the residual category. If something is not short-term, something is not post-employment, something is not termination, it is other long-term benefit. For example, a jubilee bonus. If you were to continue in a company for silver jubilee, 25 years, you don't need to retire. You will still get some benefits. That is not a short-term benefit, not payable within 12 months, not a post-employment benefits, because it is payable before retirement. It is other long-term benefit. So how will the accounting happen? Well, for each of them, let us say we first start with the short-term benefits. Short-term benefits can be including something like salary. We'll record it as and when salary is incurred, service is rendered. Second, for bonus, as and when the obligation for bonus arises, like in a performance bonus when the bonus is declared. In case of other types of bonus like retention bonus, when you complete the specified period. Or there are some profit sharing plans where you have 5% of the net profit. So when the profit is earned, an obligation to pay to the managing director, for example, arises. Then you have something called as compensated leaves. Compensated leaves are like paid leaves where they can be accumulating, that is you can carry them forward, or non-accumulating, that is you cannot carry them forward. Okay, if they are called as vesting benefits, vesting benefits would mean that you can encash them. So over here, if you carry forward or don't carry forward, leaves can be encashed. If they are encashable, that is, they are vested benefits, you will directly create a provision for the entire unutilized leave. So you had a 30-day leave, you utilize only 10 days, the remaining 20 days directly create a provision. Because you can either utilize it in the next year if you can carry it forward, or you can encash it, and hence you will create a provision. However, if it is non-vesting, that is you cannot really claim an encashment, in that case you will see whether you can carry it forward. If no, then you can't carry forward, you cannot encash, in which case there will be no expense, no provision to be recorded. However, if you can carry forward but you cannot encash, in which case you can say that okay, I will probably utilize the leave in the next year, and as a result you should create a provision because the leave accrues in the current year, maybe utilized in the next year. So long story short, in case of compensated absences, if it is vested benefits, that is you can encash them, always create a provision for the unutilized leave. If it is non-vested, in which case you see whether it can be carried forward or it cannot be carried forward. If it cannot be carried forward, the unutilized leave will lapse and hence no provision to be recorded. If it can be carried forward, then create a provision for the unutilized leave to the extent you expect it to be utilized. That is the general rule for short-term benefits. Next, you look at post-employment plans. These are benefits which are payable at or after retirement. There can be 2 types of post-employment benefits. There can be defined contribution or defined benefit. Defined contribution would be plans where the amount of contribution is defined. Like if you have to contribute 12% to a government's provident fund, the amount of contribution is defined. Or you have taken a group medical insurance, the premium that you have to pay is defined. So the accounting for these plans is very simple. You record the expenses for the contribution amount as and when the contribution accrues. However, when you look at the defined benefit plan, here, irrespective of whether you contribute or you don't contribute, your liability as an employer, like gratuity 15 by 26 into last drawn salary into completed years of service. You are making some contribution, assuming the employee will leave after 10 years and his last drawn salary will be 50,000. But when he leaves, his salary becomes 1 lakh. You will have to pay him whatever is the amount. So the calculation over here for a defined benefit plan, that is a plan with the actuarial risk, the risk of a liability or investment risk, that the investments may fall insufficient, is with the employer. In case of a defined contribution plan, the risk is not with the employer, it is with a third party, like maybe an insurance company in a group medical claim plan, or like a provident fund in case of a provident fund. So when we look at the defined contribution plan, the risk of the liability being more or less, investment falling short or not, is not on the employer, and hence we don't need to predict the liability. We will directly record expenses based on the contribution. Whereas in a defined benefit plan, the amount of liability has to be calculated, and we being chartered accountants or simple CA intermediate students will find it very difficult to determine the amount of liability, and hence even in practice we need help from actuaries, and actuaries will help us in estimating the liability amount, and they will do some actuarial valuation. So we don't have to at CA inter level go into a lot of depth for actual valuation, but we'll understand the important terms nevertheless. There is some theory on the types of plans, like state plans are by the government and hence they are usually defined contribution. Multi-employer plans are like plans like mutual funds where various employers pool their money. Whether their contribution or benefit depends on the features of the plan. If nothing is available, you can solve considering a defined contribution plan. If there is group plan where there is a Tata group which has so many companies and they have formed a plan, this is usually a defined benefit plan because the risk is within the Tata group only. And insured benefits, we are small people, we don't know, we don't have these plans. We give money to the LIC and say that give us a plan where I can pay them a pension, in which case the risk is on the LIC generally, and hence a defined contribution. This can come for an MCQ or theory. I don't see a full-fledged question on this. Okay, key terms in case of a defined benefit plan. This is a complex working for which we have had a detailed example over here. You can refer that in your leisure time if you have. The key terms over here in case of a defined benefit plan is a current service cost. What is the current service cost? The benefit that arises due to current year service. Because you rendered current year service, there is some benefit that arises, that is called as current service cost. Second, interest cost. Well, interest cost does not necessarily arise due to service but due to passage of time, because the plan you thought money will have to be paid after 5 years. 1 year has gone by, so money is now going to be paid after 4 years. That is due to passage of time. Another 1 year goes by, money is going to be paid after 3 years, passage of time. And as a result, this is called as interest cost. Next, you have past service cost. What is past service cost? Sometimes the organization changed the plan. Like earlier, you had promised to pay 1/2 into last drawn salary into completed years of service. I amend the plan and I say I will pay you full months, 1 month salary, or 3/4 into last drawn salary to completed years of service. This is called as past service cost. Past service cost will usually be taken to the P&L immediately if the benefits vest, or if the benefits remain unvested, then you will defer it over the vesting period. It's a little complicated. Past service cost is something where your amount that you have to pay increases, whereas curtailment is something where the amount that you have to pay reduces. Like earlier the promise was to pay 1/2 into last drawn salary into completed years. Now you revise the promise to only 1/4 into last drawn salary into completed years. So you have curtailed, reduced the benefit. So again, past service cost or the gain or loss on curtailment will go to the profit and loss only. Then there is some actuarial gains or losses. Now one needs to remember that when you look at, let us say, these plans, you have to make so many assumptions that when will the employee retire, what will be his last drawn salary, then what will be the inflation, what will be the discount rate. Do you think these assumptions will remain the same? No, they will keep on changing, and hence the value of the liability may keep on changing as the actuary keeps on changing his assumptions. These gains or losses are called as gains or losses due to changes in actuarial assumptions, which will also be taken into the profit and loss account. So these are 5 key terms. Okay, current service cost, cost arising due to current year service. Second, interest cost arising due to passage of time. Past service cost or curtailment arise due to plan amendment. The plan itself undergoes a change, and actuarial gains or losses arises when the actuary changes the assumptions. How do you find the liability? There's a fairly big example, but the liability, there's an opening liability. As per actuarial valuation, why should the liability increase? Because the employee renders service in the current year, current service cost. Liability is credited. What will be debited? Sir, profit and loss. P&L will be debited. Second, because 1 more year has passed, passage of time, interest, what will be debited? P&L will be debited, liability will be credited. Third, maybe past service cost. Past service cost, whether it is vested or unvested, whatever is amortized will be taken over here. Next, you have curtailment. Any gain or loss on curtailment will also go to the P&L if any. However, there can be changes due to actuarial assumptions. So, if there are any changes due to actuarial assumptions, that will also be taken in your working in the profit and loss account. Generally, you can find the gains or losses due to changes in actual assumptions as a balancing figure. You said that after doing all of this, your closing balance is not tallying, that is because actuary must have changed the assumption, and hence the balancing figure is attributable to changes in actuarial assumptions. Then you have something called as plan assets. What is plan assets? Like there's a plan liability. Like you have provident fund to pay, and for paying that you have earmarked dedicated assets to pay that. These are called as plan assets. At what value do you record plan assets? Or fair value, not at cost, not at cost or fair value which is lower, at fair value. Why? Because you need to figure out how much exact money you have to pay these liabilities. And second, where do you show these plan assets? Or on the asset side of the balance sheet? No, you show it as a reduction from the plan liabilities, and only the net amount will be shown. It is like saying that debtors minus provision for bad debts, you show the net amount, or assets minus provision for depreciation, you show the net amount. In a similar way, there may be 1,000 liability and 800 worth of plan assets, which means I will show only the net 200 amount in my balance sheet, 1,000 liability minus 800 of plan assets, and hence 200 of net liability will be shown. So plan assets will be shown at fair value, and second, they will be reduced from, let us say, the plan liabilities to show the net amount in my balance sheet. Now when I look at my plan assets, why should plan assets change? Well, during the year, plan assets can earn a return. So over here there could be interest, plan assets account debit to interest income. Interest income will technically go to the P&L, but because plan assets are going to be reduced from the liabilities, income earned on those assets should be reduced from the expense on those liabilities, and only the net amount will be shown in the P&L. You need some practice on this. Okay, we have a separate dedicated video entirely on entire AS15. If you need some practice, please refer that video on AS15. If possible, I'll share a link over here, but otherwise you can refer the AS15 video because it is fairly complex. Other than that, why should it change? Well, the entity may contribute money. Entity may contribute money in the plan assets as it wants to make more and more investment in the current year. During the year, employees might leave. If they are leaving, benefits will have to be paid. So when benefits are paid, I will sell my plan assets, get some cash, and use that to pay off the benefits. P&L will not be impacted. However, again over here, the standard says that the interest that you calculate over here, if my opening plan assets were, let's say, 100 and my expected rate of return was 10%, over here 100 plus 10, however my actual return may be something different. My actual return may be 12 rupees, in which case there is a changes in return, that is 2 rupees over here, and my closing will be 112, for example, assuming no contribution or no benefits paid. So this 2 rupees will also be called as changes in return on plan assets, which will also be going into the profit and loss account. Okay, so this is regarding plan assets. Then there is a concept of asset ceiling, which is not really important from a CA Inter perspective. So if there is an asset ceiling, then you will have to give effect to the changes in asset ceiling, but that is going to make it even more complex. Let us keep it simple. So in my balance sheet, net deficit or surplus should be shown in the balance sheet, only the net amount subject to asset ceiling in case of a surplus, if any. So this is your final amount to be shown in my balance sheet. Closing liability, let's say 1,000 minus plan assets, that is 100, that comes to 200. However, there can be some unamortized past service costs, like if for unvested plans. So like we have mentioned over here, past service costs. For vested plans, it will directly be taken to the P&L, but for unvested, let us say past service cost unamortized to liability. So let us say liability increases by 100, but the vesting period is, let us say, 4 years. So in the first year, 25 goes to the P&L, 75 will remain as unamortized past service cost, but that is a debit balance. So I will not show it as an asset, rather I will show this as a reduction from the liability over here, and my net amount to be appearing in my balance sheet will appear. Other long-term benefits, the accounting is going to be exactly same as the post-employment plan, and termination benefits you will record as and when the obligation to terminate arises. Remember, for something like VRS, etc., the moment you announce the VRS scheme and employees accept, that is when you create a provision for termination benefits, and only take the benefits which are attributable to termination. If there is a benefit which is linked to service, that is not taken as a part of termination benefits. If it is linked to termination, that is when you will take it. Okay, so this is regarding AS15. I would say that this is a very complex standard. Have a broad understanding and proceed. If you want a detailed understanding, then please refer the separate detailed video of AS15 that is also there on YouTube only for your benefit. So next we go to AS16. This is a standard on borrowing cost. I would rate this standard as important. So when you look at the accounting treatment, what does borrowing cost cover? Usually borrowing cost is referred to as interest cost. Interest. Let us say if there's a bond of 100 rupees, 10% is the coupon, that is 100 into 10%, 10 rupees is the interest. But that is interest cost. The heading of the standard is not interest. It is a much more wider term. So apart from interest, it also includes other items like discount on issue of bonds or premium on redemption of bonds, or processing fees, transaction charges, or ancillary expenses which are connected. So all of that is also included in case of borrowing cost. In fact, if you were to take a finance lease and you pay interest on the lease liability, even that will be taken as a part of the overall borrowing cost. So these are the four standard items. There's also some item regarding exchange rate which we will discuss, but the four items of borrowing cost would be interest, discount or premium on issue or redemption. Then you have processing fee or ancillary charges. Next you have interest on lease liability in case of, let us say, a finance lease. So these are the four items that you know for borrowing cost. But what do you do with the borrowing cost? Well, it is a cost which has to go to the P&L. Usually yes. However, if the borrowing cost is incurred for something called as a qualifying asset. Again, what is a qualifying asset? Qualifying asset is an asset which necessarily, ordinarily takes a substantial period of time to be ready for its intended use. That is usually having a time gap of more than 12 months unless otherwise specified. Then the borrowing cost for such a qualifying asset will be capitalized along with the asset till the time it is ready for use. So over here, this standard says that if there is a borrowing cost incurred for a qualifying asset, then till the time the asset is ready for use, the borrowing cost for that will be capitalized. For every other asset and for every other borrowing cost, it will always go to the P&L like it usually does. Okay. Now, next you look at this one particular thing which is a little complicated. Exchange differences, to the extent they are treated as adjustment to the interest cost. Now what happens is, for example, when you take a long term loan, for example of $100, you would take it in US, it is just 2%, in India it is 10%. So over here apparently there is an interest saving of 8%. So why does this interest saving arise? Well, if there is a genuine saving, people are not foolish enough to take loans in India. People still take loans in India because they know that if they take a loan of $100 today, when the rate is, for example, 80, by the time they go to repay it, the rate will become 85, 88, 90, 95, 100, and hence what you save apparently in terms of interest, you will compensate through principal, and hence the standard believes that there is some hidden borrowing cost included within that foreign exchange loss on principal. So there are a few steps that you have to remember if you want to find this. So step number one is find the actual interest. So that is a $100 loan into 2%, that is $2 of interest into the rate on the date when interest is paid. Okay. Second, you will find the rate and the interest if the loan was actually taken in India. So if the loan was actually taken in India, it would be, let's say, $100 into 80, that is an 8,000 rupee loan, and this 8,000 rupee loan, you would have paid, let us say, 10% interest, that is 800 rupees. So you will find in step 3 the interest saving, the actual interest saving, which will be, for example, 800 minus the actual interest that you are paying. This is the interest saving. However, you will find the exchange loss. So 80, and now the rate is 85. So let us say 85 minus 80, that is 5 rupees per dollar into $100, that will give you the exchange loss. So this exchange loss over here will be taken as in step number 4, interest adjustment and exchange loss, and then lastly you will take the adjustment. What does the law say? Borrowing cost, that is exchange difference, to the extent they are taken as adjustment to interest cost, which means whichever is lower. So over here, if there is a 1,000 rupee exchange loss and this is 800, then the remaining 200 will be taken as a forex loss in the profit and loss account. So basically, ideally, if you look at AS11, the entire loss on loan will be taken to the P&L only. However, if let us say we take this adjustment, then the exchange loss to the extent of interest adjustment will be taken as a borrowing cost to be capitalized. So independently you can get a question on this. Remember, this treatment will apply only if you were to take the exchange gain or loss in the P&L. If you were to follow that para 46A treatment of taking it in the FCMI TDA or adjusting it against the asset, then this treatment does not apply. Again, what are the 5 steps? Actual interest. Second is the notional interest had you taken the loan in India. Step 2 minus step 1 will be your interest saving or interest adjustment. Step 4 is the actual exchange loss. That is the closing rate minus the opening rate into the loan amount, and then the actual amount, that is exchange differences. Step 4, to the extent they are considered as adjustment to interest costs. Step 3, whichever is lower will be taken as borrowing costs, remaining if any will be foreign exchange loss. Okay, this treatment is applicable only if the entity is not following para 46A. Okay, then you look at timing of capitalization. Three important dates: commencement date, suspension date and cessation date. When do you commence capitalization? Commencement date is the later of the date when the loan is taken, activities commence, or expenditure incurred, whichever is later, that is the commencement date, and you will continue capitalization till the asset is ready for use. So substantially all activities to get the asset in the ready to use condition are completed. So this is the period. So if there's an under construction property, under construction house that you have bought, then from the date of commencement of activities, you have given the down payment, loan is taken. From that date, capitalization will start and continue till the time you get possession of the house, that is, or let us say the house is ready for use. However, in the intermediate term, let us say if the work gets interrupted due to factors which are not necessary to get the house in the ready to use condition, let us say there is a lawsuit, and this interruption is for an extended period of time, in which case capitalization, you still have to pay interest to the bank, and capitalization for that period is interrupted because there are no activities happening to get the asset still in the ready to use condition. So three important dates: commencement, cessation as well as suspension. Then there are two types of borrowings. One is specific borrowings, which are taken specifically for the purpose of qualifying asset, like a housing loan is specifically taken for the purpose of acquiring the house. It's a specific borrowing. In such a case, your actual borrowing cost from the commencement date will be capitalized, less income on temporary investment of surplus funds, if any. That is pertaining to specific borrowings. General borrowings are not specifically taken for the purpose of the qualifying asset, and hence borrowing cost, if any, attributable to the general borrowings, you will capitalize using a specific step. That is, over here, if there's general borrowing, you will first see if there's any specific borrowings and utilize money out of that. Second, you will calculate something called as the capitalization rate or weighted average borrowing rate, where in the numerator you will take actual interest on the general borrowings, and the denominator, the weighted average borrowings will be taken. So that will give you the average cost of your borrowings. And once you find this rate, also called as capitalization rate, you will multiply it by the expenditure incurred out of the general borrowings. Like if the qualifying asset has 100 rupees of cost and there was a 20 rupees specific loan taken, then the remaining 80 is the expenditure incurred out of the general borrowing into the capitalization rate will give you, let us say, the amount eligible to be capitalized. You compare it with the actual borrowing cost, select whichever is lower, and that is the borrowing cost to be capitalized. Again, this is something that you will need some practice on, and there is a detailed example also that is shared over here for all the possible complexities that can come in this particular section. Okay, that takes care of AS 16. I would recommend that you do some practice over here, numerical practice for that foreign exchange wala adjustment as well as the general borrowing cost capitalization wala adjustment, two particular ways. Next, you go to AS 17. This is on segment reporting. This is more of a disclosure standard. So when you look at segment reporting, a segment report has to be given in the notes to accounts. It is not like a cash flow statement, which is a part of the core financial statements. It has to be disclosed, let us say, in the notes to accounts. Further, how do you identify your segments? Well, segments are different business or geographical components which have different risks and rewards characteristics. So over here, it is possible that you are a business which is having different businesses like Mahindra. It has different businesses like software, automobiles, club, Mahindra, etc. And it is also present in different geographies like Asia, Africa, America, etc. In which case, there will be two business segments, two segment reports, one based on business, one based on geography. Which of them is the primary segment, which will require a detailed disclosure, and which of them is secondary, which requires a summary disclosure? That is what you will have to decide based on what the management believes is the more important one. However, an important point for you to know is if the management does not really have a clear view, in which case the business will be treated as primary, geography will be treated as secondary. Okay. Next, so this is all theory level. Next, from an exam perspective, you have two things which are important. One is reportable segments. You have, let's say, 10 segments. Does that mean in your segment report you will show all the 10? No, you will show the material, the important ones. So how will you find the reportable segments? There is something called as a quantitative threshold, where you say that the bigger ones should be reported. The smaller ones can be clubbed and shown as others. So the bigger ones, how do you quantify that? Quantitative thresholds, there are three parameters. First, segment revenue should be greater than or equal to 10% of the overall segment revenue, or second, segment result or profit should be greater than or equal to approximately 10% of the result, And last, segment assets should be greater than or equal to 10% of the overall segment assets. So three important characteristics: segment revenue, profits, as well as assets. Now revenue, the important points over here is segment revenue can be internal as well as external. So over here, usually in my P&L account, I will take only the external revenue, that is the revenue from sale to an outsider. However, in case of segments, there may be one segment like the mining segment who is selling to the steel segment, and as a result, my segment size will be gauged by both external as well as inter-segment revenue. So when I look at segment revenue, I will take both external as well as inter-segment revenue over here, as you can see. Again, I will take only operating items over here. Like if I'm an audit department, then in my audit department, whatever is the audit fees is my segment revenue. However, if I've kind of won some lottery winnings in audit, or I've put some money in deposits and earn interest, that is not linked to audit operations, and hence that will not be taken as segment revenue. It is only the operating revenue that will be taken over here. Segment revenue, segment assets, segment profit will all be only linked to operating assets which are there, or operating revenue or profits which are there. Now segment assets is simple: only those assets which are operating in nature, like debtors, like inventories, like fixed assets, they are operating in nature. Non-operating items like investments or deferred or current tax assets will not be a part of segment assets. Segment profit, how do you calculate it? Well, segment revenue minus allocable segment expenses. The problem over here is revenue will be positive, it can't be negative. Assets will be positive, total assets, not net assets, will be positive, cannot be negative, but profits can be positive and negative as well. And hence you can't just take 10% directly. So the standard over here says that 10% of what? Well, you will take the 10% of total segment profits or total segment losses, whichever is higher, and ignoring the sign. When you look at your threshold, ignoring the sign, so if your total segments have 1000 of profit, 800 of losses, and hence for the company as a whole you have a 200, you will not take 10% of 200. No, that will not be taken. You will take higher of the two, and hence you will say, okay, 1000 into 10%, that is equal to 100, and 100 may be your profit, it may be your loss. If your segment has a loss greater than 100, you will report. If your segment has a profit greater than 100, then you are a big segment, you will report. So this is a finer point within, let us say, segment profits. Other than that, there are some additional criteria as well. Now, if your segment meets any one of these criteria, it will be taken as a reportable segment. You will have to show this in your segment report, in the notes to accounts. However, if your segment is a smaller segment, but you as a management want to disclose it, like Tata has a Tata Click or Tata New that they have formed, it's not as big today. However, they want to show the readers that they are doing something in an emerging space, and as a result, they want to show it separately. If you want to show it separately, you can, management choice. Also, if, let us say, if it results in a better comparison with what is shown in the earlier years, for enhancing comparability, also you can show segments. But the most important of this will be the 75%, the criteria, the big picture test. That is, your segments that are selected should have a revenue which is external revenue, which should cover at least 75% of the total external revenue. That is when you will say that that is a complete report. If your selected segments only constitute 60% of the external revenue, then you will keep on adding segments randomly till the time at least 75% of the external revenue is covered. This will almost always be a hidden adjustment that you have to check in your main exams. Like if there are 10 segments given and you are being told that show us the reportable segments, you will put the first three criteria, find 3 or 4 as reportable and show everything as others. No, before you show everything else as others, see that whether the total external revenue, not total internal plus external, total external revenue is greater than 75% of the company's total revenue. If yes, then that's fine. If no, you will have to keep on adding segments till the time that total external revenue is kind of met. That is important from an exam perspective. And then you have presentation of segment report. Usually institute at CA Inter does not ask you as many segment reports, but if it does, you should be aware. Preparation of segment report. What will you show in the segment report? Well, segment revenue, including the breakup of inter-segment as well as external revenue. Segment profits, along with the reconciliation with the net profit, because segment profit is segment revenue minus allocable segment expenses. There may be some expenses which are unallocable, some segment expenses which are non-operating. All of that, as a layman, they should be able to reconcile with the net profit. So allocation of reconciliation of the total segment revenue with the net profits. Segment assets, again with the reconciliation with total assets. Segment liabilities, again with the reconciliation with the total liabilities, and additionally capital expenditure and depreciation. So what are these 7 items that have to be shown? Revenue with breakup of internal and external if applicable. profit with a reconciliation with the net profit of the company, assets with again a reconciliation with the total assets, liabilities again with the reconciliation with the total liabilities if there are any non-operating liabilities like loans for example. Last, capex and depreciation have to be separately disclosed. This will give you the primary segment report, a detailed report. However, secondary segment report will be much more compact. It will just show external revenue breakup, assets breakup, geography wise for example, and capex. You are not again made to show reconciliations. You don't even have to show the profits because it's a much more summarized presentation. Two key points which may be important from an MCQ standpoint is if you prepare a consolidated segment report, then you don't need to necessarily prepare the standalone segment report. It becomes optional. Remember, segment is probably one of the only places where you have such a luxury. Otherwise, if you prepare consolidated balance sheet, you still need to prepare standalone balance sheet. But if you prepare the consolidated segment report, you are not mandatorily required to prepare standalone segment report. It is fine. And second is, if you are a company having a single segment operating in a single geography, then you just have to give a disclosure in the notes that since an entity has a single segment and a single geography, no separate segment report is actually required. So that takes care of AS 17. Next you go to AS 18. This is on related parties. Now when you look at related parties, again this is a disclosure standard where in the notes to accounts I need to show the related party transactions as well as names and the relationships of my related parties. But before I go to the actual report, I need to figure out who are my related parties. So identification of related parties, individuals or entities where there is control, that is more than a 50% stake, are related parties, or joint control like a joint venture are related parties, or a significant influence like an associate having greater than 20% stake can be taken as related parties. So control, that is holding, subsidiary, fellow subsidiary, joint control, that is joint venture, associates, etc. are related parties, and then individuals. Maybe there are companies who are controlling you, but maybe like Mr. Mukesh Ambani is controlling Reliance Industries. Individuals along with their family members or relatives who are having control, joint control or significant influence will also be related parties, or entities over which such individuals including relatives have control, joint control or significant influence can also be related parties. Apart from that, there is something called as a key managerial personnel. So till now we have only spoken about ownership, that is money related relationships, control, joint venture, associates, individuals having control, joint control, significant influence, or enterprises over which those individuals have control, joint control or significant influence. These are taken as related parties. However, when you look at key managerial personnel, these are individuals who are responsible for planning, directing, controlling the affairs of the entity. These key managerial personnel are responsible for the day-to-day affairs of the entity. Like, can an accountant be a KMP? No. Can an article clerk be a KMP? No. However, the directors, especially the executive directors, the CEO, the MD, the CFO, these are taken to be key managerial personnel. So they along with the relatives will also be taken as related parties. So identification of related parties is something which I would say is a relatively important discussion that you should do. Okay, so relatives will include over here children, parents, brothers, sisters. Key managerial personnel, as we said, are usually function heads, CEO, COO, CFO, etc. Control arises from having a greater than 50% equity stake or having a control over the composition of the board. Joint control is like a joint venture, and significant influence is usually arising if you can participate in the financing or operating policies. We will study this separately in AS 23, where you usually have a greater than or equal to 20% stake, but not more than 50% stake, in which case you have significant influence. Now, what are not related parties? Trade unions, major supplier, major customer, banks who are giving you loans are not taken as related parties merely because of these items. However, there is government. So if I have a government company where government owns 100% stake, but government owns 100% stake in Bank of India, Bank of Baroda, State Bank of India, ONGC, Indian Oil, all of these will be related parties. So for government and government only, they have given an exception that if two entities are related to each other merely because they are either controlled, jointly controlled or significantly influenced by the government, then you may not give the disclosure. So if I am in the books of ONGC, I don't have to write down all my other government companies as related parties because the control is with the government. There may be thousands and thousands of companies. So to remove that burden, we are saying that, let us say, if it is controlled by the government only, then you don't need to give a separate disclosure regarding the same. So over here, you have, let us say, exclusion. Further, one needs to remember that who are related parties. Well, key managerial personnel are related, whole time or executive directors are taken as related parties, but sometimes independent or non-executive directors are not taken as related parties. Now sometimes what happens is, there are two entities where there are common directors. Merely because there are common directors does not make them related parties. Just remember that companies which merely has common non-executive directors do not make them related parties. Now the second part over here is a related party report. Now I've never seen a sum in your exam where you are asked to prepare the report. So preparation of a report is not important, but the constituents, what is there in the report? Well, name and nature of relationships. Usually, if there is control, you will always give the name and nature of relationship. Other than control, you will give a name and nature of relationship only if there have been transactions during the year. Second, disclosure of transactions and outstanding balances. Transactions can be sales, purchases, loans given, loans taken, assets sold. All of these transactions, even guarantee given, can be a transaction. And then outstanding balances like debtors, creditors, loan balance, etc. You will have to give a disclosure of transactions and outstanding balances in the notes to accounts. Here, you have to give both standalone and consolidated both. Further, sometimes it might happen that related party transactions are happening at fair prices, arm's length, or the amounts are very small. Does that mean you will not disclose? No, the standard says that the fact that the amounts are happening, transactions happen with the related parties, by default they are treated to be material transactions, and hence irrespective of the size, you will have to give a disclosure for these related party transactions, even if they are at arm's length, fair price, or the amounts are small. A lot of questions are asked on this slide where the accountant says that I don't need to disclose because they are at fair price. No, you still have to disclose. Or it might happen that the transactions have been happening in each of the month. There are sales. However, related party relationship came into existence only in the last 6 months. Then in my P&L, I will show the incomes, expenses for all the 12 months. However, in the related party report, I will do that only for those 6 or 12 months, 6 or 7 months when the related party relationship was in existence. Disclosure needs to be given only for the period when the related party relationship was in existence and not for the entire year necessarily. Further, you can club, total up and show the related party transactions with subsidiaries as a whole, associates as a whole, joint venture as a whole, and so on. Also, you can show the transactions with individual entities. They can be separately disclosed at the option of the entity over here. Okay, so this is AS 18. More of a disclosure standard. Over here, there is one contentious issue which students generally feel in case of AS 18, especially in case where something like this comes. Let us say there is P holding a 51% stake in S and S holding a let us say I think 40% or let's say 51% stake again in S1. So P in S1, just for our knowledge, institute solutions have been contentious earlier, but now the treatment that you should say is, does P have control over S1 or does it have merely significant influence? Because 51 into 51 will come to approximately around 26. 51 into 51 comes to around 26.01. No, that is just dividend rights. Control is the ability to direct. So you will say that if there was a meeting in S1, then P will order S, direct S to vote for the entire 51% stake in a manner it wants. And it's ideally, if I had to answer, I would say that the relationship is that of a control. I will not merely do 51% into 51% and say this is 26% and hence there is significant influence. I will say no. This is dividend right. So if S1 distributes a dividend of 100, 51 will go to S. S distributes 51 ka dividend, then only 26 of dividend will approximately reach P1. However, control is not based on how much dividend will you get. Control is based on how you can direct. Well, with this 51% stake, P can order S to vote for the entire 51% in S1 in a manner it wants, and hence I would say that P controls S1. Okay, that is one point where students usually have a problem. Institute solutions have also been a little inconsistent over here, but the latest material I think takes this view and solves, which in my opinion is correct. Next we have AS 19, AS 20, which are also both fairly important topics. We have detailed videos on AS 19 along with important questions, AS 20 along with important questions uploaded on YouTube separately. So if you want to view that, you can do that for AS 19 as well as 20. So for, we have detailed videos for AS as we speak. There will be more videos in the future, but if you are giving the September 2024 exams, you have AS 15, AS 19, AS 20, AS 23, AS 27, AS 25. For all of these, you have detailed videos as well. Okay, so let us go to AS 19. So AS 19 is on lease. What is lease? Lease is basically a rental transaction. We'll say what is the big deal over there? If you take an asset on lease, you are paying rent. Rent should go to the P&L. Rent account debit to bank, P&L account debit to rent. Okay, there is a general treatment if AS 19 was not there. However, AS 19 says that every lease has to be segregated between an operating lease or a finance lease. What is a finance lease? Finance lease is a lease where the risk and reward of the asset is substantially transferred to the lessee. Okay, so when is it a finance lease? The standard gives 5 circumstances. That is, if the lease has an option to transfer ownership at the end of the lease term. Like for example, in case of a hire purchase transaction, there is an option to transfer ownership at the end of the lease term. It is similar to a finance lease. Second, the option to transfer is there at a price which is at a very reasonable price. Okay, a finance lease. Or there is no option to transfer ownership. Sorry, there is no option to transfer ownership. However, the lease is for a major part of the economic life. So there is more than 75% of the economic life. So substantially all benefits are going to be enjoyed by the lessee. Or the present value of minimum lease payments substantially cover the fair value. Or the asset is of such a highly specialized nature that it can be used by the lessee only and by no one else. I'm really sorry. So when we look at these 5 criteria, if any one of those 5 criteria is getting satisfied, that is ownership is automatically getting transferred, or the option to buy is there at a substantially lower price, or lease term covers a major part, that is more than 75%, or PV of MLP covers substantially, that is more than 90% the fair value, or the asset is of a highly specialized nature. If one of them, you can see or in the middle, is satisfied, then it becomes a finance lease. So when is it an operating lease? It's a negatively defined item. So if an asset is not a finance lease, then it is treated as an operating lease. Fair enough. Now before you go to the accounting, a few key terms. That is, what is a lease term? Well, that is a non-cancelable period plus renewal period, only if it is reasonably certain that the renewal will happen. MLP, minimum lease payments, will include, let us say, the actual lease rent agreed, the fixed rent, plus something called as a guaranteed residual value that the lessee has to pay. Unguaranteed residual value will not be taken. What is the guaranteed residual value? For example, it depends on the agreement or negotiation. We might say that every year you have to pay 100 rupees, but at the end of the 5th year, you have to pay me a lump sum 50 rupees. That is 50 is GRV. Guaranteed, you have to pay. Or the agreement might be that after 5 years, you will give me an asset. If I go to sell that asset, I will get some amount, let us say of 50 rupees. You have to give me that guarantee that I should get 50. If I don't get 50, you have to pay me 50. That can also be 50 guaranteed. Lessee will have to pay if the lessor does not get that amount, for example, depending on the terms. But guaranteed amount that you have to pay will be taken as a part of your minimum lease payment. So what is not a part of minimum lease payment? Contingent rent. That is rent that is dependent on sales or something, will not be a part. Or unguaranteed residual value, because it is not minimum, will not be a part of minimum lease payment. Or maybe expenses or other taxes that are paid, but they are more in the nature of your own expenses, like electricity bill that you are paying. Well, that is not a rental cost, that is more of a electricity cost, and hence that will not be a part of your minimum lease payment. So MLP for the lessee and lessor will usually be the same. That is what the lessee pays is usually what the lessor receives. However, in certain cases, lessee says, I don't want to pay anything, but the lessor says that okay, lessee will not pay, but I go to someone else and get a guarantee to receive money from someone else. So your MLP for the lessor can include MLP for the lessee plus, let's say, GRV that the lessor is going to get from any independent third party. That can also be taken. Interest rate implicit in the lease. Remember, in the rent agreement, there is no interest rate mentioned. It is just said that you are taking an aircraft on rent for 15 rupees for a period of 10 years. There's no interest rate. Like in a loan, there is an interest rate. However, uh, if you take it as a finance lease treats it as a borrow and buy arrangement, and hence you will have to find a hidden interest rate, which should ideally be the lessor's IRR if that is available. But let us say if the lessor's IRR is not separately available, then you will take the lessee's incremental borrowing rate as the interest rate implicit in the lease. Then we have initial direct costs. These are costs which are incurred at the time of acquiring the asset under lease, like brokerage, stamp duty, registration, etc. Now, accounting treatment in the books of the lessee. Lessee is a person who takes it on rent, depending on whether it is a finance or operating lease. If it is an operating lease and you have taken an asset on operating lease, there's no entry on initial recognition, but every year your entry will be rent account debit to bank and P&L account debit to rent. Easy working. But if it is a finance lease, you treat it as a borrow and buy, and hence you will record the asset and record a corresponding lease liability. The problem is at what value will you record it? Well, you will record it at the lower of the present value of the minimum lease payment or fair value, whichever is lower. That will be asset and lease liability. Now, each year what will happen to the asset? Well, it will be depreciated. Over what period? Over the lease term or over the life of the asset, depending on the term. Like, for example, if finance lease is because it's like a hire purchase, 5 years is the lease term, after that ownership is automatically going to get transferred, in which case I will depreciate it over the life of the asset. However, there's no ownership transfer option. Asset is having a life of 15 years, you are given it on lease for 12 years, then you depreciate it over 12 years, because after that you have to give the asset back. So you will depreciate the asset. Generally, if nothing is given on a straight line basis. Second, what will happen to the lease liability? Well, you record interest. So let's say we have agreed to pay a rent of 100 rupees for a period of 5 years. Discount rate is 10%. So into PVAF at the rate of 10% for a period of 5 years comes to 3.791 approximately, that is 379 will be my asset and the lease liability. So depreciation will be 379 divided by 5, I think 75.8, and lease liability every year 379 into 10%, that is equal to 37.9 will be your interest. However, your opening balance is 379, on which 38 is your interest, but every year 100 is going to be paid, and in closing mein, this is 379 plus 38 minus 100 comes to 317. Second year 317, 32 is the interest less 100, and hence this is around 249 and so on. So you will try to calculate interest in each year. Your journal entries typically will be depreciation account debit to asset, and for liability, interest account debit to liability, for example 37, for example 32, whatever it is, and then liability account debit to bank, that is equal to 100. This will be as if you have taken a 379 loan, and using that loan you have bought an asset. This is how your accounting is going to happen. Okay. Next, when you look at operating lease, the only challenge over here is the standard says that the lease rent over here will be recorded on a straight line basis unless any other systematic basis is more appropriate. Like, let us say you have agreed to a rent of 10, 20, 30, 40 for a period of 4 years. The rent is not equal. Says, is there any reason? Are you getting more area each year because of which you are paying more rent? No. In which case the total rent is 100 divided by 4, that is 25 per annum. And hence your entry will be in the first year rent account debit 25, but to bank only 10. So you will have a deferred rent account of 15. Second year rent account debit 25, to bank 20, to deferred rent another 5. But in the third year rent account debit 25, to bank 30, and hence deferred rent will be reversed by 5, and in the last year reversed by another 15. This is to be done if there is no systematic basis. But if there is a systematic basis, like there is more rent because of more area, then you don't need to do straight lining. Or there's more rent because of inflation, escalation at 10%. No need to do straight lining. Okay, accounting in the books of lessor. Now, in the books of lessee, for example, if it's an operating lease, it's a rent expense. In the books of the lessor, that's a rent income, bank account debit to rent income. Again, on a straight line basis, unless any other systematic basis is more evident. Further, when we look at, let us say, lessor, if operating lease is there, the asset is still in the books of the lessor, and hence there will be depreciation in the books of the lessor because they have not de-recognized the asset. There is no entry at initial recognition. But when the lessor gives out an asset on finance lease, substantially all risk and reward is transferred to the lessee, in which case the lessor will have to de-recognize the asset. So, it will credit the asset, debit a lease receivable in case of lessee, I create a lease payable or a lease liability. If for a lessor, I will record a lease receivable. At what amount will I record? These are important words over here. You will record it at something called as net investment. How do you calculate net investment? Well, it is a present value of gross investment. Okay, but how do I calculate gross investment? Gross investment is the total minimum lease payment plus the unguaranteed residual value. You will also include the unguaranteed residual value over here, which means when you take the net investment is calculated as the present value of minimum lease payment plus present value of even unguaranteed residual value. Sir, why? Because if you are in the books of the lessor, you will not take any random discount rate. You are in the books of the lessor, so your discount rate will be the IRR, and IRR is a rate where PVCO equals PVCI. And when you calculate PVCI in capital budgeting, you don't just take the cash flows, you also take the salvage value, whether guaranteed or not. Go back to your FM. You take the cash flows, whether it is guaranteed or not guaranteed, and hence when we calculate, let us say our IRR, unguaranteed residual value must have been taken by the lessor, and hence in order to record this lease receivable, to ensure consistent accounting, because your discounting rate will be based on IRR, you should also take unguaranteed residual value. If you understand the logic, well and good, but from an exam perspective, remember, when you are in the books of the lessor, not in the books of the lessee, you will record the lease receivable at PV of MLP plus the PV of unguaranteed residual value. What is unguaranteed residual value? Lessor believes he will get 50 on the asset. Lessee has guaranteed that I will give you 20 if you don't get anything. I said, no, 20 to theek hai, lessee is guaranteeing, I am going to get 50, and hence the 30 is unguaranteed. That will be taken in my net investment. So three important terms which are lessor specific terms is gross investment, that is MLP plus unguaranteed residual value. Net investment is the PV of MLP, that is PV of MLP plus the PV of UGRV. It is the present value of gross investment, and there is something called as unearned finance income. That is the difference between gross investment and net investment. So if the question asks you any of these three terms, be mindful that they are asking you to show the accounting in the books of the lessor only. Okay, and then you have a special case on sale and lease back. What happens in case of a sale and lease back? You are selling the asset, let's say an asset of 100, you are selling at 120, you are selling the asset. So there's a 20 rupee gain. Ideally, the gain should go to the PNL. However, if you are leasing it back as a finance lease, then the risk and reward of that asset is not really transferred, and hence you cannot recognize that 20 in the PNL immediately. Rather, you will have to defer it over the period of the lease. So if the lease back is a finance lease, defer the gain or loss of 20 in the ratio of depreciation. But if the lease back is an operating lease, yes, that means the risk and reward is transferred, and hence ideally the gain or loss should be transferred to the PNL. In general, if the selling price is less than or equal to fair value, this is equal to a normal case. Normal case, if you want to sell something, you can give a discount, and hence the gain or loss should be recorded in the PNL if required. However, if the sale price is greater than the fair value, which is very unusual, why would someone pay you more than the fair value? And hence the standard assumes that the difference between selling price and fair value, that is, for example, selling price is 120, fair value is 105. So this difference of 15, you will defer over the lease period. The other, let's say, selling fair value minus WDV, that is 105 minus 100, 5 rupees you can take it to the PNL immediately, whereas 15 rupees you will defer. Selling price minus fair value deferred, whereas fair value minus WDV, you take it to the PNL immediately. Okay, this is a quick overview for AS19, that is on leases. Next you go to AS20, which is on earnings per share, another important standard. EPS is a very important item. In fact, it is one of the only items which is required to be shown on the face of the income statement. There are two types of EPS, basic as well as diluted. Both of them have to be shown on the face of the income statement. How do you calculate basic EPS? Basic EPS is calculated as net profit available for equity shareholders, that is after deducting preference dividend. Why just preference dividend? After deducting everything, all expenses, taxes, current and deferred both, prior period items, extraordinary items, preference dividend, everything, the pool of money which is available to pay equity shareholders divided by weighted average number of equity shares. Sir, why weighted average number of equity shares? Well, because in the numerator you have profit which is for the period item, denominator we have shares which is technically as on date, and hence in order to ensure consistency we will take the weighted average number of shares in the denominator. What will be the weight? So time for which those shares were outstanding would be taken as weights. Secondly, what if there are partly paid up shares? So we will convert them into equivalent fully paid up shares and then take that into our calculation. So what if there are shares where calls are made and money is paid later? Then we will say that if the shares are 80 rupees, 100 shares, and then another 20 is called up. So this is 100 rupees worth of shares. So these are 100 shares. So we can say that it is like 80 rupees worth of shares were outstanding for, let's say, 3 months, and for the remaining 9 months you can say 100 rupees worth of shares were outstanding. Next, there can be shares which are issued without consideration, something like bonus shares or share split, in which case the standard requires you to make a retrospective adjustment from the earliest reported period. So if you have a 2024 and then a 2023, then irrespective of the date when these bonus shares or shares were split, you will assume that they were issued on 1st of January 2023 from the earliest reported date, because bonus shares do not give you any consideration. If shares are coming for consideration, then yes, we would say that that will result in you having some money which you can deploy and earn a profit. Bonus shares is just a book entry. Share split is just a book entry, and hence you will assume that they are in existence from the earliest reported date. Okay, right shares is a fairly important adjustment. In case of right shares, there's a hidden bonus and there's a hidden issue for consideration as well. So you will take 3 steps. Step number 1, you will try to find the theoretical X rights price. So let us say the rights ratio is 1:4. That means for 4 existing shares, you will get 1 right share, and the pre-right price is 150 rupees and the right issue price is 100. In which case you will say that for me to get a right share, I will have to have 150k 4 shares, then for 100 rupees I will pay for 1 share. So I will have to pay a total of what, 700 for getting 4 plus 1, 5 shares, and hence my average price per share would be, let us say, 140. But pre-rights my value was, let us say, 150. So 150 divided by 140, that is equal to, I think, 15 by 14 or 1.111 will equal to, for example, your rights adjustment factor. Or let's say this is what, 1.07, I think, 150 divided by 140, 1.0714. So how will you calculate the EPS? Well, you will multiply the rights adjustment factor to the shares outstanding prior to the date of rights issue. So prior to the date of rights issue, let's say there were 10,000 shares. We will say 10,000 into 1.0714 prior to the date of rights issue. After the date of rights issue, 10,000 shares ke upar you got, let's say, 2,500 shares. You would have taken 12,500 in total. But prior to the date of rights issue, you will treat it as a hidden bonus, and we will retrospectively adjust all the earlier periods. Gains over here, it is preferable if you calculate on a cumulative basis. That is, for the first 3 months there were 10,000 shares into 1.0714. For the last 9 months there were, let us say, 12,500 shares into 9 by 12, etc. Next we have diluted EPS. What do you mean by basic EPS? That is the actual EPS. But what do you mean by diluted EPS? It is the worst possible EPS if the potential equity shares convert into actual equity shares. Now the thing is, what is potential equity shares? These are equity shares which have the potential to become, these are instruments like convertible debentures, convertible preference shares, warrants, etc., which have the potential to become equity shares, but they are not equity shares as we speak. So when you take diluted EPS, what do you say? Well, what if these potential equity shares like convertible preference shares get converted? In which case, what will be my EPS? Well, in such a case, I will start with the basic EPS and I will say that if these preference shares were converted, then I don't have to pay them preference dividend. So in the numerator, I will add back preference dividend. In the denominator, I will add the number of shares that I will have to issue, and the EPS that I get is going to be called as a diluted EPS. If the debentures convert, I don't have to pay them interest. But remember, if I don't have to pay them interest, the tax saving that I am getting on interest will also be reversed. So interest into 1 minus t, I will add back in the numerator, in the denominator, the number of shares that I am going to issue. And that will give me my diluted EPS. Remember, the word diluted means it is lower. Stake dilution means stake reduction. It is not potential EPS, it is diluted EPS. So if my basic EPS, for example, was 10 and my so-called diluted EPS comes to 9.5, I will take the diluted EPS as 9.5. However, if my diluted EPS is 10.5, then on conversion, there is anti-dilutive effect. That is, the EPS is increasing, in which case I will say that no, 10.5 cannot be taken as the worst possible EPS. This is diluted EPS. So if it reduces, then I take it. If it increases, I ignore it. Okay. A challenge arises in case of stock options or warrants, in which case you will try to find the incremental shares. You will not do the working directly. People say that in the numerator, I don't pay any expense to the options, and hence 0 will be adjusted in the numerator. That is fine. However, if there were 1000 options, for example, which convert into shares, and let us say the exercise price is 25 rupees, in which case I would say that if these options were converted at the beginning of the year, I would have received 1000 into 25, that is 25,000, which I could have deployed in the business and earned a return. Remember, when debentures convert, preference shares convert, I don't get any cash in my hand. However, when the options convert, I do get cash in my hand, which I could have deployed and earned a return. So I say no. If the options convert at the start of the year, I will issue 1000 shares, but at the same time, I will get 25,000 in my account. What will I do with that? Well, I don't know. I will use that to buy back my own equity shares, is what the standard says. But if I go to buy back my equity shares, I will have to buy back at the market price. Let's say the average market price is 50, in which case 1000 into 25 divided by 50 comes to 500. So I will issue 1000 shares, get some money, use that to buy back 500 equity shares, and only 500 incremental shares will remain, and that 500 incremental shares will be taken in by denominator in case of options or warrants question. It's a slightly technical working. So what if in a question there are multiple instruments which are potentially convertible? Can I blindly take all of them? No. Then 3 steps have to be followed. First, you calculate incremental EPS, that is a cost saving like preference dividend saved or interest into 1 minus T saved, divided by the number of shares issued. Rank the securities in the ascending order of diluted EPS. So lesser the cost saving, more the dilutive effect, and then solve on a step-by-step basis. So you took the basic EPS 1 lakh divided by 10,000, then add only one of them. Find if the EPS is diluting, perfect. Then on a cumulative basis, add the second one. Is it further increasing? Okay, perfect. Add the third one and so on. Step by step, cumulative basis. Presentation and disclosure. EPS has to be shown on the face of the income statement, both standalone and consolidated, basic and diluted. If there are extraordinary items or if there are discontinued operations, then you will also show EPS from discontinued operations or extraordinary items separately. However, a challenge might arise that it might be possible that on including diluted potential shares, your EPS from continuing operations, let's say, is 100, 10 rupees, your basic EPS is 10. There are 5 potential equity shares. If I include 100 divided by 15, this will further fall. Okay, it will become, I think, whatever 100 divided by 15 comes to, let's say, 6.67. It is dilutive. However, what if there were discontinued operations where there is a loss of 200? Divided by 10, this comes to negative 20. But if I put 200 divided by 15, well, this comes to 13.33. Your loss per share falls. That is anti-dilutive. So which of the two is more important one? Well, the standard says EPS from continuing operations. So if inclusion of this 5 additional potential equity shares dilutes, that is reduces my EPS from continuing operations, I will include that 5 on discontinued total all other operations as well. So that is regarding control number. For diluted EPS, if it falls, it is dilutive. If it rises, it is anti-dilutive and has to be ignored. So that takes care of AS20. Between that 20 and 22, there is a standard called as AS21, which is on consolidation, which is a full-fledged discussion. We have a separate video where we have just discussed consolidation concepts. It's a slightly old video, but you can still refer that at the time of this recording. And one video where I've also tried to do a few sums. It's best if you do consolidation and amalgamation separately, because the process of consolidation and amalgamation itself is another 2-3 hour discussion along with, let us say, sums. So consolidation AS21, we will kind of do it separately. Next, you have, if possible, you can refer the video if you need help on that. But if you have already done using a particular method, you stick to that and focus currently in this video for accounting standards only. Next, you go to AS22, which is on deferred taxes, another problematic area which the students do face. So we'll continue further into AS22, which is on deferred taxes. Now over here, or income taxes, there are a few terms that you should be aware of. First is accounting income, that is profit before tax that you calculate as per books of accounts. After taking accounting revenue minus accounting expenses, that will give you accounting profit. And then you have income tax base profits, maybe that is calculating profits as per tax rules. So you will take revenue as per tax principles minus expenses also as per tax principles, depreciation, section 37, etc., and you will come to the taxable profit. Now, should they be the same? Well, if they were same, then your paper 1 and paper number 3 would also be exactly the same, but unfortunately they are not, and hence you have to study 2 papers. So they can be different. So what are the reasons of these differences? There can be certain timing differences, like for example depreciation. Ultimately, if the asset is 100, you will get depreciation of 100 only. or section 43B items where you will get a deduction in books as and when the interest on scheduled commercial banks accrues, but in income tax only when you actually pay them. These are all timing differences, whereas certain differences are permanent differences, like donations to charitable institutions. If they are unregistered, books will give you deduction. It does not really matter, but income tax will never give you deduction. So these are other than temporary, or also called as permanent differences. So what does deferred tax stand on? Deferred tax says that, well, remember, your computation of income that you do as per income tax is a private document. You don't publish that in the annual report, but when you publish your income statement, that is as per books of accounts, accrual principles. But the current tax that you are paying is based on what is the profit as per income tax. Your profit as per books may be, for example, 100, profits as per income tax may be 80, and hence your current tax will be 80 into, let us say, 30%, which will come to 24. So when a reader does not say 80, reader does not say anything, reader says on 100 profit you are paying a tax of 24. That's quite cool. However, the difference of 20 may be due to depreciation, where income tax is giving you more depreciation now, but it will give you lesser depreciation in the future. And hence, one needs to remember that this difference of 20 is temporary in nature. 20 ka difference between accounting and income tax ka profits is temporary in nature, and temporary items give rise to deferred tax. And hence, for this 20 ka difference, the difference between accounting and taxable income, or the difference between depreciation as the case, maybe into 30%, that comes to 6 rupees. So this will result in a deferred tax liability. Now, identification of asset and liability is another headache, but when you look at deferred tax liability, when will deferred tax liability DTL get created? It will get created when the accounting income is greater than taxable income. Taxable income is lower, that means you are paying lesser tax now, but if you are paying lesser tax now, you will have to pay more tax in the future. So that will be a DTL, deferred tax asset. When it be a deferred tax asset, when your accounting income is less than the taxable income, so your certain expenses have been disallowed as per income tax. So your taxable income is higher, so you are paying more tax now, but you will pay lesser tax in the future. Let is like an asset for you, like a prepaid item. You pay more now, you pay less in the future. Accrued expense, you pay less now, but you will have to pay more in the future. So this is the birth of deferred tax. It is a tax effect due to timing differences. For permanent differences, there is no deferred tax, because ultimately you are not going to get a deduction in the future, or the other way around, you don't have to pay more tax. Like donation to charitable institutions, books might have given you deduction. Income tax will never give you deduction in the future, so there's no point creating a DTA or a DTL for that. Okay, tax expense will be current plus deferred. So difference between accounting income and taxable income can be timing, can be permanent. Timing will create a deferred tax liability or an asset. No deferred tax to be created on permanent. If nothing is given, usually the differences are assumed to be timing differences. A few examples are discussed over here, and after that you have the deferred tax calculation. So over here, accounting income is greater than taxable income. Why would that happen? Well, because maybe in accounts the revenue was more than tax, or in accounts the expenses were less than that of tax. That is when the accounting income will be greater, in which case ultimately deferred tax liability is created. Like, for example, income tax gives you a higher tax deduction for depreciation, or accounting income is less than taxable income. Well, taxable income is greater. Why? Because you might have paid a 43B item. However, sorry, you might have not paid a 43B item. In books, interest 100 crores into 10%, even if not paid, you will get a deduction. Income tax says if you have not paid it, I will not give you a deduction, and as a result, in income tax, there is no deduction over here. But you are not having a deduction now, but in the future, when you will pay it, you will get a deduction. So this is called as a deferred tax asset. A classic case of a deferred tax asset is a carry forward losses. Remember, carry forward losses in books, if there's a loss of 100 rupees, it gets recorded in the current year. In the next year, is a profit of 100. In the books, next year there will be a profit of 100. But in income tax, if there's a loss of 100, it will be carried forward to the next year. When there's a profit, 100 minus 100, 0 rupees will be shown in the income tax return of the second year. So carry forward loss helps you in paying lesser tax in the future years when you get that as a deduction. And hence, carry forward losses create a deferred tax asset. So over here we have mentioned briefly when does a deferred tax asset or a liability gets created. Usually when accounting income is greater, it will be a deferred tax liability. When accounting income is lower, that will be a deferred tax asset. That is a general rule. Okay. Offsetting in my final balance sheet, generally I can offset deferred tax asset and liability, and I will show net generally because assets and liabilities are coming out of the same Indian income tax law. However, if it is coming out of some other law, like one item is coming out of US tax law, one is Indian tax law, then you cannot offset, you will have to show them separately. Now, when will you create, what is the entry for a deferred tax liability? Deferred tax expense account debit to deferred tax liability. And what is the entry for deferred tax asset? Deferred tax asset account debit to let's say deferred tax expenses, which will go to the credit of the P&L. So over here, the principle of prudence and conservatism will go for a toss. So over here, when you look at expense, we are chalo, theek hai, record kar diya expense. But for income, you have recorded income. What if you actually don't get that? Like for example, carry forward losses have only an 8-year life. What if you are not able to earn profits in those 8 years? In which case, you recorded an income, but well, you know what? At the end, you will not get any benefit. You will not get any tax savings. So the standard says deferred tax asset can only be created if there is a reasonable certainty that it will be utilized, uh, or for carry forward losses, it is virtually certain that you will earn reasonable profits to actually claim deductions and set off for the same. So creation of DTA, in detail there is no conditions, but DTA is subjected to certain conditions. A few other special cases are what applicable tax rate, like for current tax for the year 24-25, you will take the tax rate of the year 24-25. However, deferred tax is going to be tax which is deferred and either paid in the future years in case of deferred tax liability, or saving claimed in the future years in case of a deferred tax asset. That will be based on the future tax rate. But no one can predict what future tax rate, like Madam Nirmala Sitharaman ji, what she will do in the future, we don't know. And as a result, over here, when we look at deferred tax, we should ideally create it based on future tax rates. But today, I don't know the future tax rate. So the standard says you will create based on tax rates which have been enacted or substantively enacted till the balance sheet date. Like there is a budget which comes usually in February. So in February budget, you will be given what is the possible tax rate of the next year. So for deferred tax, you can take that tax rate. For current tax, which was earned for profits earned in that year, you will take the same tax rate. But for deferred tax, you will take tax rates which have been enacted or substantively enacted, like the budget is given till the balance sheet date. Now, there can be something called as MAT. MAT, you will study at a lot of length in your final CA, but MAT is minimum alternative tax. So, over here, MAT, as you will study further, is not really a tax. It is just paying something now. In the future, probably you will get MAT credit as well. So, when you calculate deferred tax, MAT, that is book profit as well as MAT rate, has to be ignored. So, they clearly say that you will calculate by comparing accounting profit and income tax profit. Profit that you look for MAT, book profit if given, has to be ignored. Further, MAT rate may be different, around 19 or 20%. Income tax rate may be different. You will ignore the MAT rate. You will do the working based on regular tax rates only. So basically, MAT, if given in the question, has to be ignored for the purpose of deferred tax. You can directly calculate deferred tax by comparing accounting profit and income tax profit at the actual regular income tax rate. MAT rate as well as book profit has to be ignored. Further, there may be special cases where there may be a tax holiday like section 80IA, 80IB, etc. or section 10A, 10B for SEZs. Over here, there might be differences which are arising and reversing within the tax holiday period, in which case no deferred tax is required, or there are differences which are created during the tax holiday period of 5 years, but reversing after 5 years, after the tax holiday period, for which a deferred tax is to be done. Not very important from an exam perspective. MAT has come in the exam, tax holidays do not usually come in the exam. If it is originating and reversing during the tax holiday, no deferred tax needed. If it is originating during tax holiday, reversing after tax holiday, deferred tax to be created. If we go into the detailed explanation, it will take another half an hour or so for this entire chapter. So we are just kind of running through the provisions that you are aware. Keep that in mind. Otherwise, wherever required, you can do a detailed review for the same, at least after your exams. Or sorry, before your exams, after this video, after exams. How does it help? So transitionary items are not really important. Next, you have AS23. We have actually, AS23 is on associates. We have a separate video for this, and we have tried to keep this somewhere at the end along with consolidation. So over here for associates, we will discuss this right now. Only subsidiary consolidation is very detailed. This is quite a small 4-5 mark question can come. Associates are entities where you have significant influence. When do you have significant influence? You have significant influence if you are able to participate in the policy making, maybe financing policies or operating policies. If data is available, that gives you significant influence. However, if data is not available, then you holding a greater than or equal to 20% stake all the way up to 50% stake gives you a significant influence. And if there is a significant influence, then you become then you are an investor and the other entity becomes your associate. If there is an associate, in my standalone financial statements, I will show the investment as an associate as per AS13. I will show it as an investment. Long-term investment typically to be shown at cost only, less permanent decrease in value if any. However, in associate, I am participating in policy making process. I am devoting my time, energy, efforts. I am sending my employees, and hence standard says at a consolidated level, the valuation over here should be slightly different using a method called as equity method of accounting. What does equity method of accounting says? It says you should not even keep your investment at cost, not even take it at fair value. Why? Because, well, associates are not holding for the purpose of sale in the ordinary course, and hence it's like business investment, and hence you will measure the value of this investment based on how the business does. That is how the equity or the net worth of the associate changes. Like initially you invested 100 rupees, that is investment in associate. Next year the associate made a 50 rupee profit. You have a 30% stake, so 50 rupees may say 30%, that is 15 rupees is attributable to you. They may not have distributed it, however this is attributable to you. So under the equity method, investment account debit to, let us say, consolidated profit and loss, 15 rupees you will add. In the next year, that 50, may say 30 or entire 50 is given out as dividend. Bank account debit, can I again record income? No, 15 is already recorded as income under the equity method. So your associate investment will be valued at the cost of investment plus share in the equity, that is reserves, can be revaluation reserve, can be foreign currency transaction reserve, can be profit and loss, your share in the reserves. However, when dividend is received, pre or post acquisition dividend, you will reduce it from the investment. It is treated as recovery of investment. You will not again take it to the profit and loss account. Now, one needs to remember that in equity method, you are just remeasuring the associate investment. You're not going to take over the assets and liabilities. Like in subsidiary consolidation, you control the subsidiary, and hence you kind of lift the corporate wheel and you take over assets and liabilities of the subsidiary. In associate, it is still a separate entity over which I have significant influence. I don't have control, and hence I can't take over assets and liabilities of the associate. The investment will be measured in a special way called as the equity method of accounting, where the share in profits or losses of the associate will be recorded and my investment will be valued accordingly. Now, since I don't take over the assets and liabilities, intercompany debtors, creditors will not be eliminated. Subsidiary are eliminated because I take over assets and liabilities. So debtor in one book, creditor in one book gets eliminated. Associate, I don't take over assets and liabilities. However, I do take over profits, and hence if there is any unrealized profit in stock, that will be eliminated. My entry will be consolidated P&L account debit to, let us say, usually investment or inventory, as the case may be, of this working. Unrealized profit has to be eliminated. Debtor creditor may not be eliminated. What appears in case of what happens in case of a profit, that you consolidate your share of profit, well, you will also consolidate your share of losses in case of an associate. Now, in case of subsidiary, you used to calculate goodwill and show it as a separate line item in your balance sheet. But in associate, you will still calculate goodwill, but because investment is still appearing, you can't show goodwill as a separate line item. Rather, you will just disclose the goodwill. You will compare the consideration that you are paying for the associate, for example, 100 rupees paid, minus the share of net assets. Maybe when you acquired the associate, its net assets were, let us say, 200 rupees. 200 into 30%, you should have paid 60, you ended up paying 100. So the extra 40 is attributable to goodwill. But I will not show the goodwill separately. I will just show the investment at 100 into bracket including goodwill of 40. I will not show goodwill along with intangibles, for example, like I do it for a subsidiary. So the goodwill has to be identified, disclosed, but not separately shown as an intangible asset. That is in case of AS 23 for associate accounting. Going back, the next standard is AS 24. AS 24 is on discontinuing operations, probably one of the least important standards. And if a question comes, usually it's a very standard type of a question that comes. So if there is a discontinuing operation, what do you mean by discontinuing operation? Basically, it's a component, it's like a division, a part, a segment of the entity that an entity plans to dispose of pursuant to a single plan. How can it dispose of? By doing a slump sale, one shot, or through piecemeal, or it abandons. But this item that it is discontinuing is a separate major line of business or geography, and separate financial information is available, can be distinguished operationally or financially, in which case till the time it is actually discontinued, after it is discontinued, it will not its income or expense will not appear, but till the time it is discontinued, it is still ongoing, it is present tense, discontinuing operations. In which case, what about the profits or losses for this operation? Well, the standard says you will have to disclose them separately. Like for example, you have a company which has 3 divisions A, B and C. Ideally, this is my total amount that I show in my P&L. But if I intend to discontinue division B, then my ideal profit should only be shown for my continuing operations, that is revenue of only 400, expenses of only 200, and so on, line by line. For discontinued operations, whatever profit that you have earned of 150 less tax impact on that will have to be shown separately. But sir, When do I start showing a separate disclosure for discontinuing operations? When there's an initial disclosure event. What do you mean by initial disclosure event? When it is the earlier of the date when you enter into a binding sale agreement or a formal plan is finalized and announcement is made. From that date, you can show discontinued operations. So when will it be a discontinued operation? Well, if you intend to discontinue a segment, sometimes what happens is you are not discontinuing, you are just rebalancing. Like for example, you were earlier making a Maruti 800 car. Now you are reducing the Maruti 800 or Maruti Alto and increasing the production of Maruti Swift. Well, that is rebalancing, that is not the discontinuing operations. Or you are earlier making a lot of passenger vehicles, you see a lot of demand for commercial vehicles, you reduce the passenger vehicles and make more of commercial vehicles, that is not the discontinuing operations. Gradually phasing off of one, let's say, old product line and making a new product line is not called as a discontinued operations. So events, and that is what usually comes in the exam. Gradual phasing off of a product or shifting of a product manufacturing from one location to another is not really treated as a discontinuing operations. Impact of the presentation, AS24 requires in the PNL I should show only for continuing operations. Discontinuing operations, if any, whatever profit was earned during the period will have to be shown separately. Okay, that is AS24, a small and cute standard. Next you go to AS25, which is another new standard which was introduced, for which again a separate video is there, or you can refer that separately. So when you look at AS25, this is on interim financial reporting. What do you mean by an interim period? Well, interim period refers to a period shorter than a financial year. A financial year may be 12 months, then a period shorter than 12 months is called as an interim period. But it is not necessary that every time a financial year has to be 12 months. Like in the year of incorporation, the first you might be incorporated in, let us say, November, then your first financial year is from November to, let us say, March, only 5 months. That 5 months is not an interim period because that is a financial year. However, if your financial year is, for example, 12-month period within which you are doing a quarterly or half yearly reporting, you are reporting for a period shorter than the financial year, which is called as an interim period. So what is the requirement? Well, the standard has two requirements, one for presentation and disclosure, where they say you can either prepare a complete financial statements like the complete annual report with complete balance sheet, profit and loss, cash flows, notes with all disclosures, or a condensed financial statements where you just give the headings and subheadings like condensed balance sheet, condensed P&L, condensed cash flow statement, and only the significant accounting policies. Condensed cash flow statement means only you show the cash flow from operations directly, don't show the entire working. Cash flow from investing, cash flow from financing, and so on. In P&L, like I show other expenses, I'll show a note on what all is there in other expenses. No need to do that. Just showing other expenses will also work. This is condensed financial statements. Now, to whom is it applicable? To any entity which is preparing an interim financial report. However, if some law requires a separate format for preparation of an interim report, like listed companies give quarterly reports, there is a specific format which is mentioned. Specific will always override general, and hence the standard AS25 is clarified that for listed companies who are preparing an interim financial report as per listing agreement, then the format given in the listing agreement will apply. Okay. Now, what are the measurement and recognition principles? Usually, you will measure and recognize items in the interim period using something called as a discrete approach. What does a discrete approach mean? If expenses are accruing during that period, record it. Incomes are accruing during that period, then record it. Achha, if the expenses are going to accrue in some other quarter, then you record it in that quarter. You ask yourself that if these were not 4 quarters, if these were 4 financial years, then if something is going to be recorded in the 3rd financial year, I don't do anything right now. So if something is going to be recorded in the 3rd quarter, I will not do anything in the 1st or the 2nd quarter. I will record it in the 3rd quarter as well. So this is called as a discrete approach. Treat each quarter separately, as if it is a separate financial year. However, for certain special items like income tax, for example, you follow an integral approach because income tax is not levied on quarterly profit, it is levied on annual profit. Like for example, if you are an individual which is around 2,50,000 income each year, then each quarter if you are earning 2,50,000, which is within the basic exemption limit, your tax will be 0 in each of the quarters. However, that 2,50,000, 2,50,000, 2,50,000 contributes and builds up to around 10 lakhs. And hence on a 10 lakh income, let us say, if you sit and calculate tax for the entire year, maybe it comes to 1,12,500. And hence 11.25% is the weighted average tax rate. So we will say that irrespective of which quarter the income arises, for every 1 rupee that you are earning, whether in the 1st quarter, whether in the 4th quarter, your tax accrual will be 11.25%. This is called as integral approach. So how do you solve for this? Well, you estimate the annual accounting income, let us say 10 lakhs. estimated annual tax, let us say around 1.1 to 5 lakhs, and calculate the tax rate, let's say 11.25%, and then for income in each quarter into the tax rate will be the expense to be recorded in each quarter. Okay, there are a few special cases over here as well in case there is carry forward loss. Again, for someone will say this is applicable for individual. What about a company? Well, there can be a carry forward loss. In case there is a carry forward loss, if you take carry forward loss over here as this is 100 loss carry forward, and in each quarter you are earning 100. In the first quarter you say 100 minus 100 0 rupees as tax, but that is wrong. Carry forward loss is not offset against the first quarter's profit, it is offset against the entire year's profit. So you will say that ideally the accounting income is 100, that is 400. Tax on that will be 400 minus 100 into 30%, that is 22.5, and hence 22.5 upon 400 comes to around 300 into 30%, 90. So 90 upon 400, this is 22.5, and that into the income for each of the quarters will give you the tax. So basically, rather than recording quarter 1 mein 0 tax and in every other quarter 30 rupees tax, we are saying that the tax saving is going to be enjoyed by all the quarters and not just the first quarter. A few special cases would be changes in accounting policies. Over here would also require a retrospective restatement. Listed companies, you will have the recognition principles like tax calculation and all of this. However, you don't really need to follow the presentation format. And in case the entity prepares a consolidated interim report, standalone report is optional. Further, if I want to show the comparative data for balance sheet, I will show the last balance sheet, that's it. For P&L, if this is the first, if this is, let us say, your relevant quarter, current quarter, let's say 1st July 23 to 30th September 23, you will show the comparable quarter over here and the cumulative year to date data, 6-month data and the comparative 6-month data. So basically, if you are in the second quarter of the year 23-24, so you will show the second quarter of the year 23-24, comparable second quarter of the year 22-23. However, you also show the year to date data, that is half yearly, from 1st April to 30th September of the current year and also of the last year. For cash flow and statement of changes in equity, you don't have to show the quarterly data, you can directly show the half yearly year to date data if comparative is asked, which is relatively rare. Sometimes the questions are also asked regarding seasonality, that you might happen that in the third quarter there's a lot of revenue but expenses are incurred evenly. So we say let the expenses be recorded in the third quarter. That is wrong. It is like Olympics, happens every 4 years. Does that mean all expenses will be recorded in the fourth year? No, if expenses are accrued in each year, you will record them in that year. So merely because there is more revenue in the third quarter does not mean all expenses or majority of expenses should be deferred to the third quarter. If you can't defer it over 3 financial years, you can't even defer it over 3 quarters. You will record expenses as and when they are incurred. Okay, so that kind of takes care of AS25. Next you have AS26. This is intangible assets. I would say this is a smaller miniature version of AS10. If you have done AS10 well, AS26 should be a sail through. Now intangible assets, when you say that intangible asset, a student generally says that when you can't touch, feel, see. However, that is just one of the criteria. Lacking physical form is just one of the criteria for an intangible asset. Apart from that, it has to be non-monetary in nature and it has to be identifiable. What do you mean by identifiable? It means it is capable of being separated out and sold separately, or it arises due to a license or a contractual right. Like for example, market share. Maruti might have a 40% market share. However, I cannot separate out and sell that market share only. And that market share is not arising out of any license or a contract. So market share, though gives me future economic benefits, cannot be separately shown because it is not identifiable. Okay. Further, you have certain deferred revenue expenses like major advertisement expenses, preliminary expenses. One might say that I've done a lot of advertising in the current year. It will give me future economic benefit. Yes, but the ads are all being displayed. Record expenses as when they are incurred. In the next 2-3 years, you are not going to display any ads. So if ads are displayed, you will record the advertisement expenses or employee training expenses or preliminary expenses in the year when they are incurred. The question will tempt you by saying that no, but you will get benefit in the future years. Remember, deferred revenue expense करके AS में कोई concept नहीं है. You might have been taught this in foundation. Accounting standards does not agree with that. It says if the expense has been incurred, accrual says you should record it. So our matching concept, well, accrual is more important than matching concept. and hence you will you will uh, you will record all expenses and not defer big advertisement or employee training or other expenses over the years. Internally generated assets, well, usually the cost for an internally generated asset is very difficult to be calculated, and hence if cost is not reliably measurable, you can't record it. Human resources, you can't control them, and as a result you cannot record them. Initial recognition of an intangible asset happens at cost, exactly the same way as PP. Purchase price, non-creditable taxes, less trade discounts if any, plus directly attributable expenses, exactly the same. Subsequent expenditure, if it increases the life or efficiency, you capitalize, otherwise you take it to the P&L, exactly same as PP. The subsequent valuation over here is usually going to be done using the cost model only. Revaluation model is usually not permitted for intangible assets. You generally take based on the cost model only, because in revaluation you can do if there is a market price available, and for most intangible assets you don't have a quoted market. Two special cases over here would be research and development. Research cost is cost during the ideation phase before you have actually hit any technical feasibility, and every expense during the research cost is going to go to the P&L because future economic benefits are not certain. However, expenditure during development phase can be capitalized if there is technical feasibility, legal possibility, product has a market, financially feasible, and cost is measurable. That is when you can capitalize. Otherwise, expenditure in the development phase is also going to be taken to the P&L. Development phase is a phase after you have hit technical feasibility, but before the product is commercially launched. During that period, if there is any expenditure incurred, you will capitalize if it meets certain criteria. Otherwise, you will expense to the P&L account. Okay, amortization. Well, what is depreciation for a tangible asset is basically amortization for an intangible asset. Amortization, if intangibles have a finite life, will be done over the finite life on a systematic basis. That can be the pattern of cash flows, benefits, etc. And if there is no systematic basis available, then on a straight line basis. Remember, revenue cannot be taken as a systematic basis. You can take units, you can take cash flows, but revenue cannot be taken as a systematic base in general. But what if intangibles have an indefinite life, like a trademark? It has an indefinite life, in which case the standard says that, well, you will amortize it on a straight line basis over 10 years, because if there's an indefinite life and if you have a systematic basis, you use that. If not, you will amortize it over 10 years on a straight line basis. Okay, if you want to cross a 10-year limit, you need to have reasons why the benefit is going to spread beyond 10 years. Like a legal life beyond 10 years can be a strong evidence, but if there is no evidence, then you will have to amortize it over the 10-year period only. Can there be a subsequent change in the useful life? Yes, in which case it is a change in accounting estimate and has to be effected prospectively. Now, the next or next to next standard that you study is a standard on impairment, and there is a concept of recoverable value over there. So, recoverable value is calculated as the higher of the net selling price or value in use. Value in use is the present value of future cash flows. If there is an intangible under development, you have to check for financial feasibility. And what is financial feasibility? If I am incurring this cost, will I be able to recover this cost? And recovery can be checked as present value of future cash flows that it will generate on utilizing the intangible. So, generally in case of an intangible asset under development, you will be given the cost incurred for developing the asset, and you will be given data to calculate a recoverable value, which is the present value of future cash flows. If you are carrying value, that is the cost incurred is for example 100, but the recoverable value is only coming to 75, that is no matter what you do, you can't recover more than 75, then the feasibility is up to 75 only, and hence the excess 25 will be taken to the P&L account as impairment loss. So over here you will compare the ledger balance with the recoverable value, select whichever is lower, and that will give you, let us say, impairment. Okay. Next you have AS27 actually, which is again more of a consolidation related chapter. So this is on joint ventures, joint operations, and jointly controlled assets. So we'll just do a very quick run through over here, but detailed problems and video, if you want, it's separately shared on YouTube. So when you look at joint arrangements happen like when there is joint control, that is shared control. How do you say that there is a joint arrangement? When two parties have to jointly direct. You can't, one person cannot unilaterally direct, so jointly direct. So there are three possibilities of structures over here. There's jointly controlled operations, jointly controlled assets, and jointly controlled entities. What is most important, I think, is the jointly controlled entities part. For jointly controlled operations, there is no separate entity in the middle. There are operations, different people have different assets, and they're just jointly controlling the assets. There's no jointly owned assets. Like you have the World Cup. There are two cricketing boards coming together. They own their own stadiums, but they're jointly organizing the schedules. Or jointly controlled assets where there's no separate entity, but let's say your mother and father jointly own a house. So that is a jointly owned assets where assets are owned jointly. And jointly controlled entity is where A and B come together, like Tata and Starbucks come together. They form a company in India for coffee business, and that company is owning assets and liabilities. That is called as a jointly controlled entity, where there is a separate entity and assets are held in the name of the entity. Okay, in the second structure, assets are held in the name of the uh, individuals as itself, in which case assets, liabilities, expenses are to be recorded in the SFS in the proportion of your holding. If I hold a house 60-40, it's a 100 rupee house, 60 is my, 40 is my wife's house. So in my balance sheet, I'll see 60. For example, in my wife's balance sheet, there'll be 40. However, if we come together and we form a company and the company owns the house, then the house will appear in the SFS of the company. In my individual books, I will see investment in my joint venture. In my wife's books, there will be investment in the joint venture. However, if AS27 applies, in my consolidated financial statements, I will follow proportionate consolidation method. What do you mean by proportionate consolidation? Proportionate assets, proportionate liabilities, proportionate income, proportionate expenses will be consolidated. Assets, liabilities, incomes, expenses are proportionately consolidated. There will be no minority interest over here. Other adjustments will continue to remain the same. So this is generally regarding the general discussion, like for AS27, though for a better understanding, best if you do it along with its problems, along with consolidation, like subsidiaries, full consolidation, associate equity method, and joint venture using proportionate consolidation if there's a separate entity. Okay, next you go to AS28, which is on where is AS28? This is on impairment. Again, a new standard for which we have put a separate detailed video for the same. So what does impairment indicate? Impairment refers to a reduction in the earning capability of the asset. So impairment arises when the carrying value exceeds the recoverable value. How do you calculate carrying value? Well, carrying value is calculated as a ledger balance. Your cost less accumulated depreciation, impairment if any, will give you the carrying value is greater than the recoverable value. Okay, how do you calculate the recoverable value? Well, recoverable value, like for inventory, you say cost or NRV, whichever is lower, because inventory is held for the purpose of sale. So the only value that you have to look at is the NRV. However, a fixed asset may be used, may be sold, and hence you calculate the recoverable value as a higher of the net selling price, that is fair value less estimated cost to sell, or value in use. That is, if I were to use it, then I will generate cash flows, present value of the future cash inflows. Higher of the two will be taken as a recoverable value. Like if the carrying value is 100, my net selling price is 70, value in use is 80, then the recoverable value is taken as 80 and impairment will be 100 minus 80, that is equal to 20 rupees. Why is 20 taken as impairment? Because the best use of the asset can yield only 80 rupees today. But you are showing the asset in your books at 100. Asset is defined as a resource controlled by the entity capable of giving future economic benefits. A reader will assume that you will at least give benefits worth 100. You are unable to give benefits worth 100. Maximum, you are going to give benefits, for example, worth 80, and hence 20 is going to be recorded as impairment and will be taken to the P&L in general. However, if there was already a revaluation done, then first you will adjust against the balance of revaluation and excess, if any, will be taken against the P&L. Now, the problem over here is, when do you do impairment? Well, like you compare it at every balance sheet date, the standard says no. You will do impairment only if there are indicators which are existing, which can be external, which can be internal indicators, like introduction of a new technology or legal ban. These are indicators that the asset will not be able to generate benefits, or continuous losses or physical damage. That is when you do impairment, because otherwise, imagine a company like Tata Steel, which is there for hundreds of years. It might have so many assets. For every asset, you have to find the net selling price. For every asset, you have to find the future cash flows. It is a very taxing process. Inventory you're selling in the ordinary course of business, so you can easily find. Fixed assets you don't sell in the ordinary course of business, and hence it will become a very tedious requirement, and hence the standard says you will do impairment testing, that is, find recoverable value only if there are indicators. If you believe there are no indicators, you don't even need to find the recoverable value. Okay. certain additional guidance which is given for value in use workings. They say that value in use when you calculate is the present value of future cash flows. Cash flows over here will be before interest, that is for debt and equity both. And the discounting factor over here will be the WACC, because the cash flows are before interest, before tax. Then the discount factor should also be the pre-tax WACC. Okay, salvage value should be included. If there was any inflation, that should also be considered. Can you reverse impairment? Yes. If the service potential of the asset increases and there is an improvement in the potential of the asset, again, like there was a legal ban earlier, now that ban is lifted, in which case impairment which was done earlier can possibly be reversed. But while doing that, you need to remember that the carrying value after this reversal cannot exceed the carrying value had there be no impairment. So you will find the carrying value had there be no impairment compared with the recoverable value. Maximum reversal can be going up to the lower of these two, compared with the actual ledger balance, and find the reversal. However, the standard is particularly stringent when it comes to reversal of impairment for goodwill. They said that ideally, if you reverse impairment for goodwill, it is possible that some self-generated goodwill might also creep in. So they say goodwill impairment usually cannot be reversed unless the original impairment on goodwill happened due to an external factor like a legal ban, and that same external factor kind of reversed. On the other hand, maybe the impairment happened due to a factor like a new technology came in, or a competitor like Jio came in and the prices were reduced. Now, I worked really hard as Airtel and I regained my market share. Now, that is actually my efforts, my self-generated goodwill. I cannot reverse and record a self-generated goodwill. However, if operations were banned and now that ban is lifted, then the goodwill that was earlier impaired can be taken as reversed, and hence goodwill impairment in that rare case can be possibly reversed. Then you go to a concept of cash generating unit. What do you mean by cash generating unit? It is the smallest group of assets which is capable of generating a largely independent cash flows. Why do I need to go to the concept of cash generating unit? Because generally every asset is not capable of generating a cash flow. Like a car can be put out on rent and generate a cash flow. However, when you look at an assembly line in a factory, it is a line of machines working together to generate a cash flow. It is not necessary that each asset in that assembly line can generate a cash flow. However, coming together, they can generate a largely independent cash flow. A company might have 50 factories, but these 4 machines in one factory are capable of generating a largely independent cash flow, so they become a cash generating unit. So how do you do impairment testing for a CGU? Well, there are 4 steps. Step number 1, calculate the carrying value of the CGU, that is the carrying value of the individual assets, plus allocable corporate assets if any, plus allocable goodwill if any. The question will tell you if there are any allocable corporate assets like common research and development centers, common training centers, common head office buildings. These are allocable corporate assets, or allocable goodwill that you might have acquired this division from somewhere and paid a goodwill. That is the carrying value of your entire cash generating unit. Compare it with the recoverable value. If the carrying value is greater than the recoverable value, there will be an impairment, and that impairment will first be allocated to goodwill, and excess if any will be allocated to every other corporate or every other asset including corporate asset in the ratio of their carrying values, ensuring that the value after impairment does not fall below the individual recoverable value. So over here we have a fairly detailed example for the same, though institute at CA inter level does not really ask you so much, but it is, they kind of ask you an identification of a CGU. But if there is an impairment requirement, there is an example which you can possibly refer for clarifying your overall understanding of these concepts. Allocate the impairment loss first to goodwill. There's a goodwill of, so there's 150 total carrying value, net selling price is 80, value in use is 90, and hence higher of the two, which is equal to 90. So your impairment loss is equal to 60. 60 means the first 50 will be allocated to goodwill, and hence the remaining 10 will ideally be allocated to A, B and C and D in the ratio of their carrying values. But if you allocate anything to A, 10 minus 1 also, so it becomes 9, but A can give you 20, so nothing will be allocated to A. B can also give you 20, nothing can be allocated to B. So whatever is the remaining 10 will be allocated to C and D in the ratio of their carrying values, that is 30:40. This is just a brief understanding. Okay, if you are not given an allocation ratio for corporate assets, usually you allocate in the ratio of the carrying value into the useful life. So carrying value is important, useful life is also important. The bigger the division, more the head office that division will use. The longer the life of that division, longer it will keep on using. So you will take the carrying value into the life as an appropriate base for allocation. But if life is not given, then you can allocate in the ratio of the carrying values. Sometimes there can be unallocable corporate assets, in which case you will do a two-tier impairment testing. A two-tier impairment testing would mean first you will do impairment testing in the usual way for the smaller CGUs without the unallocable corporate assets. So you will not allocate anything. Let's say head office is not allocable. So you will do impairment testing without the head office for each of the small divisions. If there is an impairment, write off that impairment and then find the revised carrying values of each of the smaller CGUs. Add the unallocable corporate asset to the larger CGU, that is the company as a whole. Compare that with the recoverable value of the company as a whole. If there is an impairment, then that impairment is attributable to the unallocable corporate asset. So you do a two-tier impairment testing, one for the smaller CGU individually without the unallocable asset. Second, once that impairment testing is done, find the total carrying value of the company as a whole compared to the recoverable value of the company as a whole. If there is an impairment, then such an impairment is due to the unallocable corporate asset. Okay, there's a special case that we have mentioned for site restoration. This is, I think, an AS29 item. We will discuss this along with AS29. And then you come finally to the last standard. So when you look at AS29, this is a standard on contingencies, provisions, contingent liabilities and assets. So many standards that you have studied on assets. Here, liabilities. What is liability? Basically, this is an obligation which will result in outflow of resources. But when does the obligation arises? When there is an obligating event. What is an obligating event? An event which creates a burden on the entity where it has no realistic alternative but to settle, but to pay. That is treated as an obligating event. So over here, liabilities are when there is a legal obligation. Legal obligation can arise out of a law or out of a contract where you have to make a particular payment. So these are liabilities which are unavoidable, which I have to pay. Does not mean I have to pay it now. A present obligation does not mean immediate obligation. If I take a loan, that does not mean I have to repay it now. But the fact that I take a loan, I have no alternative but to repay the loan as and when the contract dates are there. Then you go to contingent liabilities. Contingent liabilities would mean liabilities where the obligation may be possible, whose outcome will be dependent on events which will be decided in the future, like a court case, or a contingent asset where I will get an inflow, but again that is contingent. So how will you do the accounting for contingencies? If it is a contingent liability, if nothing is given, it is uncertain, 50-50 chance, you will just give a disclosure in the notes. However, if it is probable, that is a more than 50% chance that payment will have to be made, then you create a provision, expense account debit to provision. But if it is remote, that is very unlikely, less than a 50% chance, 5% chance, then you will ignore. Contingent assets, prudence and conservatism kicks in. They says that even if it is probable, you will just give a disclosure. However, if it is uncertain, you will ignore it altogether. You will only record it in your books if it is virtually certain, that is going beyond doubt. There is no estimate, beyond doubt. The court gives its verdict. That is when you record it as a receivable in your books, not otherwise. Virtual certainty arises from facts. Probable means more likely than not, more than 50% case. Reimbursement if there is. So if I am incurring an expense of 100 and someone has agreed to reimburse 50% of that, that means I will show only the net 50 as expenses. Okay, you can offset and show the net amount. How do you measure the provision? Using expected value method. So that is probability based weighted average. If there are more than two possibilities, or most likely values, if there are exactly two possibilities, 90% I will lose the case, in which I will have to make the payment of 100 rupees, 10% I will win, in which case I will not have to make a payment. There is a 90% chance. Most likely I will have to make the payment, so I will create a provision for the entire amount. However, if there are more than two possibilities, so there is a 60% chance that I will lose, pay damages, 30% chance pay high damages, 10% chance I will pay no damages. Then I'll more than two possibilities, I'll take the probability based weighted average. Okay, while measuring the provisions, I do it on a pre-tax undiscounted basis. I will not take the let us say present valuation, except if it is provision for site restoration, where that note was there in AS28 as well. For provision for site restoration, the standard allows you to take discounting. That is, if I expect that after 10 years I will have to dismantle, but the obligation to dismantle arises the moment I construct the nuclear plant. I am allowed to take the present value only for the present value purposes for the site restoration. So over here, this kind of takes care of all the 29 accounting standards. There is also this section at the beginning where you have applicability of accounting standards. If I kind of do a very quick overview, institute might ask you questions over here, but it's a little less important. Accounting standards are given by our beloved ICAI, the Accounting Standards Board, and notified by the MCA. standards can be applicable to corporate entities because Companies Act requires you to do that, but for non-corporate entities also, if they want to get it audited, then they will have to follow accounting standards. So applicability of Ind AS to corporate entities is mandatory. For non-corporate entities is optional. If they want to see a certificate or a report, then they will have to probably get their accounts audited and follow AS. Now for companies, there is two segregation. There is small and medium companies and there is non-SMCs. So how does small and medium companies defined? Entities which are not listed, having a revenue of less than 250 crores, loans of less than 50 crores, and should not be a parent and subsidiary of a non-SMC. These are small companies where a lot of relaxations are provided. If you are not a small company, then you have to follow all accounting standards. Similarly, when you look at non-corporate entities, there is level 1, level 2, level 3. Again, you have been given thresholds looking at the revenue and loans. 250 and 50 will be level 1. Between 50 to 250 or between 10 to 50 of loan is level 2, and between 10 to 50 of revenue or 2 to 10 crore of loan will be level 3, and then level 4. Now there are different relaxations which are provided. From an exam perspective, you just need to remember the limits, and remember that in case a non-SMC becomes an SMC, it will not be entitled to the above exemptions unless the company remains an SMC for 2 years. And in case a company is classified as an SMC, it gets full or partial exemption from the below standards that are mentioned. So this is regarding the applicability of accounting standards as well, and I hope you are having a fair bit of clarity with all the accounting standards with this session. If you do like the session, please do like, share and subscribe with your friends. If you need anything else to be specifically covered, please do mention that in the comments box, and I will try to upload that in the best possible time. So that should be it. Thank you very much for your time and patience. Wish you all the very best for your exams. Do really well, give it your best shot, and keep rocking. Okay, good luck, goodbye, take care.